So we're now recording. We're live and ready to kick off. So, Bisera, I'll let you on. Invite you to do a quick intro, if that's okay.
Okay, so good afternoon, ladies and gentlemen. Hopefully all of you are doing well today. So it is a pleasure to welcome all of you and thank you for applying to this webinar. So my name is Bisera and I am the founder and sales manager in the Scally Learning. As most of you know, the Scally is a company that offers corporate trainings with various trainers from all over the world. And we can proudly say that so far we had participants like from Switzerland, Monte Carlo, Slovakia, Slovenia, Netherlands, Kosovo, Bulgaria, North Macedonia, and many, many more. So I must say it is a great moment for us to have Mr. David Holland here today, as he is one of the most experienced coaches in the world. He has won a series of awards, including Best Client Result Coach of the Year. And having now worked with clients in 37 countries, and he published over 45 books on business and personal development. So in the name of the Scally team, I would like to welcome all of you to the Financial Masterclass for Business Owners, and I wish you an educational, fun, and networking experience. We can start, David.
Sarah, thank you very much. That's great. I'm just going to mute everybody just so there's no background noise. Welcome. Thank you for the introduction. Bisera, very, very kind. Yeah, my name's Dave Holland, and I'm going to do a very quick overview of my background, my experience. As we go through this this workshop, we're going to have a break around about halfway through for a comfort break or a coffee. So just relax. There's plenty of time for that. If you have any questions at all, I'm going to pause occasionally and just ask, do you have any questions? If you do, please, any questions, fire them away, and I'll do my very best to answer them for you. If I can't answer them for you during the workshop, I'll make sure we get some notes back to you outside. Bisera can send them over for you. So we'll kick off and see how we get on. So Financial Masterclass for Business Owners. And first of all, I'm going to touch on this as well. I'm not an accountant, but I am a business owner, entrepreneur. My background is I'm an engineer by background. I've worked in the logistics, packaging, aviation, recruitment, transport sector for a number of years. And we started this business, Lynn and I, and my son, he works with us in the business here nearly 20 years ago now. So we're now doing our 20th year. So we work with clients all over the world. But please, I'm not an accountant, but I want to approach this from a manager, business owner, entrepreneur perspective and look at financials in a way that are operationally based, things that can be helpful if you're running a business, maintaining a division. What should you look for? What should you measure? And what do some of the terms mean? So we'll just build that as we go along. So this is where I am based at the moment. We are here. There's the blue pin. We're just outside Luxembourg, living in France in a little renovation cottage we bought during the lockdown. We have an office over in Schengen, which is up in Luxembourg, and over in the UK as well. And we've been here now for about, in Luxembourg, 12 years. Went from the UK to the USA, based out of Nevada for a few years, and then over here based out of Luxembourg and France. We have clients, as Bisera was saying, 34 countries, 37 countries actually now all over the world. I only speak English, and that not very well sometimes, I'm afraid. I do tend to speak very fast. So if I go too quick or I use phrases or things that are not quite clear, just drop me a message. I'll repeat. I can go back again. I do tend to speed up. And if I am going too fast, put your hand up and I'll slow down. I do understand that, of course. Again, I'm not an accountant. So what I'm going to be able to talk about is the operational aspects, business owner, operational entrepreneur aspects of finance. I'm not going to be talking about rules, regulations, and compliance and tax rules and tax treaties, that type of thing. We have accountants to do that for us. I'm approaching this from a management business operations perspective. So I hope that's okay. At the end of the workshop, and we're here for about 3 hours, there'll be a recording which will be available to you. The slide deck will be available to you as a PDF. There's a couple of ebooks I'm going to be able to send across for Bisera to send to you as well, and a couple of templates. I think there's a budget template I'll happily share with you. That will all come over to you. So you're welcome to obviously take notes if you'd like to, but the full set of notes and a copy video will be available to you as well. So to kick off, there are three main documents. If I'm running a company, as we do, and maybe you do as well, there are three main documents I want to be aware of and want to manage the business with. The first one being the income statement, or the profit and loss account. P&L is the first one to look at. What I recommend is you have a P&L, profit and loss, every month. A lot of companies get a P&L once every year. A financial statement comes out, you finish your financial year, and then sort of 6 months later, when the year is done, the accountant sends you your P&L, your profit and loss account statement. It's way too late. A P&L should be a regular working live document. We get a P&L for our companies once every month, 6 days after the end of the month. We get our profit and loss, which means we can look at how did we do last month in terms of the sales profit margins we'll come on to. So income statement is first, got to have one of these. The more regular, the better. Quarterlies may be okay. Monthly, my experience is probably better all round. Next one is the cash flow statement. And this is a measure of cash. Obviously, is what's called a cash flow statement. The P&L does not necessarily measure cash. It measures transactions. And I'll touch on this a little bit later on. P&L measures transactions. Cash is different. It measures basically cash coming into your account and going out of your account. It depends on your accounting system and accounting structure. We'll touch on this a little bit, but don't confuse the two. They are totally different, and you need to have both. But when you look at your profit and loss account, you may have a very profitable business, for example, the gross profit and net profit, very, very strong, and yet you've got no money in the bank. Your cash flow can be really bad. It doesn't mean you're not profitable. It means there's a problem somewhere else in the business in terms of debtors or creditors and payment, this sort of thing. We'll touch on that as well. So must get a cash flow forecast or cash flow statement. Where's your cash going? I get a daily bank reconciliation, excuse me, sent through to us. We operate in 3 countries. We own France, Luxembourg, UK. I reconcile across all 3 territories, and it's just to make sure that, you know, based on our cash flow forecast, we will know what should be in which account. Not every day particularly, but, you know, within a week, a few days, we should know what's going on, and we reconcile that to the bank account. So I recommend you do have a cash flow statement, cash flow forecast as well, predict where your money's going to be, and then you can just check your bank as you go along. One of the best things about a cash flow forecast, if anybody in the workshop is looking to grow a business, which I assume everybody by definition is, but you need some funding for it. So if you go to the bank or the financiers and say, look, here's why I need the cash. Here's my forecast for a business in terms of sales and profit. And here's my cash flow forecast. The banks, they really know a fast growing company will use up a lot of cash because you're buying, you know, stock, you're hiring people, you're investing in marketing. It drags cash at the front end, and the growth may not come through quite as quick. So high growth, fast growth companies, they need a lot of cash to fund it. If you go to the bank with a profit and loss business plan, but a cash flow forecast, and you can show them why and where you need the cash, not guaranteed, but they're much more likely to, you know, to understand you've got control of your business. You know why you need it, where it's going to go, where it's going to come from, and it goes in your favor when it comes down to getting some sort of loans and funding. The only reason the bank's going to lend you money is so they can get it back. And if you can show them through cash flow where it's likely to come back from, then they like all that. So cash flow is a very important document. And the third one is balance sheet. Which is a snapshot of the business. It's not cash, it's not cash flow, it's not profit. It basically is a balance sheet, which is what do we owe, what do we own? That's it. The assets and liabilities. There's a lot more to it than that. I don't worry too much about the balance sheet on a monthly basis. I'll have a look at it quarterly, look for movements and that type of thing. But the balance sheet is really how you assess the overall performance of the business. How have we done this quarter or this year? Investors are very interested in this, for example. Are you using funds appropriately? Have you got assets that are being used, or have you got massive liabilities coming through in the business as well? So we're going to touch on these a little bit later on as we go along. But if I'm managing a business or managing a company as a managing director, general manager, I need these 3 things. There are other documents I need as well, but these are the 3 fundamental ones. I recommend you get them. So that's the first thing. The first one to look at then is the profit and loss account? What does that look like? If you're used to doing this, this may be very basic for you. So I'm going to run over everything in a generalized way and just give maybe a refresher for some people and new for others. This is how the profit and loss works. It's basically sales, cost of sales, then you have gross profit, overheads, and net profit. That's the churn through. That's your basic fundamental structure of a set of profit and loss accounts. So let's say we've got sales of 10,000. Now, cost of sales, and we're going to touch on this a little bit more as well. A cost of sale is a cost that is directly attributable to the good or the service that you're providing. So if it was me in my business, for example, let's say I have a sale of 5,000 euros and I have a trainer going to deliver a workshop somewhere. They charge me 2,000 euros. Well, that trainer is a direct cost, a cost of sale of that delivery. So my cost of sales are 2,000 and my sales figure is 5,000 or 6,000. So the cost of sales is what is directly attributable to the production or delivery of the good or the service. That gives us a gross profit. 10,000 minus 6,000 gives you gross profit, GP. And we're going to look at a percentage in a second or two as well. So when people talk about what's your gross profit or gross margin, maybe they talk about gross margins. You may hear the term contribution as well. If you're in a division, a part of a range of companies, the accountants like to give us these long words to get confused over. Gross profit, GP, gross margin, contribution, same thing. It's basically forget your overheads, what the front end of the business, what you're selling and what it's costing you to produce that product, that good or that service. Are you making a profit on it? So hit this one, 10,000 sales. This could be a week or a month or whatever it is. Cost of sales, 6,000. GP, gross profit, 4,000. Overheads in the business. Overheads are everything else that is not attributed to cost of sales. Typically, overheads would be rent, power, electric, gas, employees that aren't directly associated with delivery, accounting fees, insurance, everything else that is not a cost of sale, a direct cost, as we'll look at a little bit later on as well. If it's not cost of sale, by definition, it's an overhead. Every cost within a business has to be accounted for on the profit and loss. This is where it all goes. So for this business, let's say you've got 4,000 gross profit, overheads are 3,000. Net profit is simply gross profit minus overheads 1,000, and that's all there is to it. Now, when you get your profit and loss account, it'll be much longer than this. Very likely much longer than this. You may have a broader sales line, different sales products from different divisions or departments or product lines, and then cost of sales might be different as well. But fundamentally, this is what you're looking for. What have you sold? What's it cost you to do it? What's your gross profit, overheads, and net profit, and away you go. What we can also do here, you'll hear this mentioned quite a lot, is gross profit percentage, gross margin. Margin tends to be a percentage term. So we're making 4,000 euros on 10,000 sales, 40% GP, gross profit. That's how it's calculated. This gets talked about a lot. If I'm managing a company, a division, I focus on gross profit. That's got to be according to budget or higher, because that is what drives everything else. Even if the sales fluctuate in terms of values and volumes over the quarter, I want to know that my gross profit percentage is holding. Things to watch out for here, for example, if you've got a sales team that are discounting, if they're out there making offers, crazy offers, buy one, get one free, or whatever it is, 20% discount here or whatever, if they start discounting, it's going to hit your gross profit, and you'll pick it up as a percentage. So watch out for that. I'm very, very clear that we do not go below a certain gross profit percentage. We look to increase it where we can, but we can't go below, because that's what drives everything else for us. And net profit or net margin, you may hear the term as well, is this one at the bottom down here. And that is just simply oops, 1 second, I'll just move my camera across so I can see everything. Here we go. So that is just the net profit expressed as a percentage of the sales figure. So 10,000 sales, 1,000 net profit, 10%. 10% net profitability. Is that good? It depends. It depends on your business, on your sector. I would aim for higher than that. If you're in a service company, for example, consulting, training, accounting, or something like that. Oh, excuse me. Just 1 second. There you go, I'm back. Is 10% good? I don't know. So it depends on your business sector. Excuse me just for 1 second. The dog is barking. Just 1 second. I'm back. My apologies. One of the joys of working from home. There we go. So that's the profit and loss account. That's the numbers you're going to look for. What is good in your business from a gross profit percentage? Depends. What is good from a net profit percentage? Again, it depends. We want to get those as high as we can, clearly. You can predict these things as you go along. So that's the first document we want. There's other details in here we're going to talk about, but I recommend you get one of these on a regular basis. Any questions around the P&L? Everybody happy with the P&L? Just please type in any questions. Everybody give me a thumbs up or something. Let me know you're alive. But everybody happy with the P&L? Okay, we're going to blast on at quite a pace. Okay, balance sheet. This is a statement. It's a snapshot of the business overall. Basically, it is just a balance sheet, 2 columns. Thank you, Ivan. You're a star. That measure 2 things: what we own and what we owe. Now, the difference between what we own and what we owe is called owner's equity, owner's valuation of the business on the balance sheet. If you own your own business, this is what you're aiming for. The reason you're doing this, running your own business, is to get owner's equity, because that's the value of the business, the valuation that you're shooting for. Now, the owner's equity goes on the liability side of the balance sheet. Things like retained profits, for example, they're not an asset, which sounds quite bizarre. You know, cash in the bank is an asset. There are current assets, long-term assets, all that sort of thing, but that's an asset. But cash is different to profit. So if you've got retained profit or owner's equity, that is a liability to the business. And the reason it's a liability is because it can be drawn out by the owners. It's owed to the owners. That's why it sits on the liability side of the balance sheet, just so you know when you see it coming through. So total assets is total liabilities plus owner's equity, and hence it has to balance. So what you can see is, if in a business you've got, if the assets and liabilities move and fluctuate, the difference between them, well, you know, you're funding that as the owners, because by definition, if the assets decrease, well, then the liabilities don't, they get very close, you're losing equity, your value is disappearing. So if you run your own company, you're the owner, have an equity target, and then manage it carefully, because this is derived from the profit and loss account to a degree, but really it's more to do with the assets, which is on the cash, liabilities, all this type of thing goes together. And what you're aiming for is equity in a business. Be very clear on what that wants to be. It's going to be from the equity where you can take out drawings, that sort of thing, if you want to, or you can sell it, or whatever it is. That's what you're aiming for. So be very precious around your total liabilities and owner's equity. But that's the balance sheet. It is just a snapshot. It can change daily, it can change hourly, because let's say you raise an invoice, or you pay a bill, or you receive some cash, the balance sheet changes. A living document, and we take a snapshot of it and say, this is where we are right now. But those are the 3 fundamental documents I recommend you have. The key one operationally is going to be the profit and loss and the cash flow. Balance sheet is more of a long-term thing. Don't worry about it on a daily basis. You can influence your balance sheet by what you do with the other 2 anyway. The other 2 are under control. The balance sheet will look after itself to a certain extent. Okay, first up then, cash flow. Just to understand, cash flow is the movement of money in and out of your account. So it's nothing to do with profitability. It's nothing to do with your assets or anything like that. It's purely what comes in, what goes out, and when. Can you afford to make payroll this month? Do you need to get a loan? You've got an overdraft, this type of thing. It's different to P&L. And the reason is you may be on, and we'll touch on this a little bit later on, again, I'm not an accountant here, but you may be on something called cash accounting, or you may be on what's called accrual accounting. If you're on cash accounting, you, for example, you will take the sale in your business on the profit and loss account, the P&L, you take the sale, the point at which you receive the money from the sale. On accrual accounting, you take the sale is taken when you send an invoice out. So I send you an invoice today, I take the sale today, but I don't get paid for another month or something. That's cash flow. Payment is cash flow, sale is when the invoice is raised. So there's a difference between profit and loss and cash flow. This is what trips most people up though. Cash is what kills a business. I've never seen a business fall over due to lack of sales or profit or margins or anything like that. It's painful, but you can get through it if you've got cash. If you've got cash in the bank or reserves, you can trade through and you're going to be okay. Equally, a very fast growing high profit business can go bankrupt because it runs out of cash, because you're paying suppliers too quick, you're buying too much stock, you're hiring too many people, and you just run out of cash. Even if you're profitable, and if you're looking to buy a business, as a quick tip, if you can find a business that's been fast growth, good strong P&L but bad on balance sheet, you can buy it quite cheap actually, because so you buy a high profit, high growth business, put some cash into it, get them back on track, and that can be quite a successful acquisition strategy again. But anyway, cash flow, it's money, it's cash in and out of your bank account. That's all it measures. So there's the fundamental principles, the basics. What I've put together then for the rest of the workshop is 26 principles that I think will be helpful for you to understand more about, things that you can measure, bring into your business, that you can control. You can use it with your teams. You can set KPIs, performance indicators for them, and really understand the levers of control, the levers of power from a financial perspective. So I've got 26 of them. And again, fire away any questions you have. These are things that I would use or have used or do use with my clients all over the world. Depends on what sector they're in. I don't use all of them with every client, but a number of them I do. And I explain a little some storyboards around behind them as well. So the first one is a key sort of commercial indicator, if you like. It's conversion rate. And what I mean by conversion rate is when you get an order coming in, or you do a quotation, you do a price proposal, you have a sales meeting. Every sales meeting you do, or every 10 sales meetings you do, how many orders do you get? How many do you win? What's your conversion rate? Sales conversion rate. If you're in a sales commercial role, conversion rate is a key, the acid test, if you like. Now, how that pans out is, for example, let's say we've got 50 orders, but we did 100 quotations to get them. So 100 quotes go out, we receive 50 orders, our conversion rate is 50%. We're winning half the quotations we're submitting. Now, when I say to people normally, what's your conversion rate? Either they say, I don't know, no idea, what's that mean? Or they think they know it, but actually they don't, because they don't measure it. And they will always overestimate. The average figure I get told is about 80%. Yeah, we're good at sales. We get an inquiry, proposal, sales meeting, whatever it is, we get about 80% of them. I know that sometimes that can be true, but regularly it's not. So a key driver in a business is, what is your conversion rate? When I started this business, which was 19, 20 years ago, my conversion rate to deliver a workshop or work with a coaching client, whatever it's going to be, was 1 in 20. So 5% conversion, which was horrible. It's horrific. It's horrible. It doesn't work. You make no money out of that. My conversion rate now is up to, because I measure it, so just over 90%. So I win 9 out of 10 bids, proposals, quotations, whatever you want to call it. I win 9 out of 10, which means I don't need that many coming in to make the business grow and develop. So this is where you have to be good at sales, or your team needs to be good at sales. In my experience, the sale is made before the sales meeting in terms of conversations and reputation and that type of thing. But conversion rates are the acid test, a key driver. And if your conversion rate is low, it means you've got a massive sales and marketing activity, to get low value sales. So it's a high cost point as well. Marketing is expensive if you're not converting to clients. Now, conversion could be a click on a website, for example. It could be a purchase online. It could be you do a bid or a proposal for a contract. It doesn't really matter what it is, but be clear on your conversion rate. What should your conversion rate be? Again, it depends. It depends what business you're in, what sector you're in. As an average, I think I'd go, if you ask me, I'd go for, should be 65%, 2/3. Let's win 2/3 of the bids you're going for, because if you're winning only 1/3, well, maybe there's something, you're either bidding for the wrong work, or your prices are too high, the value's not perceived. There's something not going on there that's quite right. So that sounds too low. Arguably, and I'll own up to this one, if your conversion rate is very, very high, 90% or 100%, well, you're probably too cheap. So put your prices up. You really want a conversion rate where you do lose a few, which means your pricing is good, in your favor, but just measure that conversion rate. You may find there'd be a conversion rate for different salespeople, for example, or different for yourself. Does anybody, just out of interest, anybody on the workshop measure your conversion rates? Who's got a conversion rate that they measure? Who's brave enough to share a conversion rate? Just out of interest, that was all. I'm always interested to see what happens on conversion rate. If you have, just type it in. But again, measure it. We measure this on an ongoing basis. Excellent, good, thank you. You'll probably find that if you haven't measured it, that because I do this as well, when you look at every price you give, quotation, proposal, whatever, there's probably a lot more going on. It'll probably be lower than you think. And I was with a client literally last week. We're over in the UK doing okay, great, thank you. We're over in the UK, and we measured for a client what his conversion rate was. Now, he thought his conversion rate was about 60%. That's what he guessed at. When we measured it, it was actually 22%, because there's a lot of things going on he hadn't measured and wasn't looking at, and he was quite disturbed about that. And I said, well, that's great. 22% conversion rate is great. And the reason is you can double it. If you're doing 80% or 65%, okay, you can increase it, but you can't double it. So when you do measure your conversion rate, be realistic with it, be harsh on it as well. If it comes out at 20%, great, then you can do something about it. And then you can put a conversion strategy in place, which may be, better marketing, better visualization between the marketing and the meeting, whatever it is, pricing, added value, or just better sales techniques for you and your team. I do see a lot of people in sales or sales roles, and we don't need to hard sell what we do, but just to be able to pitch and discuss and demonstrate and show value, have that level of conversation can make a dramatic difference to conversion rate. So it gives you some tips and ideas of what you need to look at in the business to improve this. That's the first one. Now, there's a second aligned sort of conversion rate with this one as well, and it's what I call sales efficiency. And this is the value. So the value of orders, average value of orders received over average value of inquiries received. And I'll explain what this means in a second or two. So let's say you receive orders in. The average value of orders received into your company is 500, and the average value of inquiries you receive, however, or proposals to deliver, is 1,000. Well, then you're 50%. So what it means is you're winning all the little jobs or the smaller jobs, and you're not winning the big ones. Now, the converse will be true as well. You may have a high percentage, if you like, where you're winning all the big jobs and not the little ones. And again, it depends strategically on where you want to put yourself. But to me, if you're winning all the small ones only, it may mean there's something in the bid, in the pitch, in the process, you're not attracting the larger clients. Conversely, if you're only winning the big ones and not the small ones, same thing applies. Maybe there's more profit in the smaller ones. Maybe having smaller orders as well spreads the risk around your client base as well and reduces dependency. We have a rule in our company, always have. When we had transport and warehousing companies, the same thing applied. I didn't want to have any one customer, one client that represented more than 10% of my sales, my revenue, because that reduces that dependency. If they go somewhere else or wander off or go bankrupt, whatever it is, if they stop trading with me and they are 50% of my sales is with one client, then I'm out of business overnight. So this comes down to this efficiency side of the business as well. So you've got conversion rate, actual inquiries to orders, and then you've got efficiency of sales, value of orders to value of quotations as well. And we do a lot of work, for example, with martial artists over in the UK, and we look at this conversion rate where they get a student, a prospective student comes along to the academy for a trial lesson. How many people come for a trial? How many sign up as a consequence? And that is normally a lot lower than they think. In your business, it might be slightly different. You may have people where it's an email inquiry, could be face-to-face sales or a closed bid, whatever it is, but the same principle applies. How many orders are you winning based on the number of quotations you're providing? And I recommend it. We measure ours on a monthly basis as one of our KPIs. And of course, when we put our prices up, maybe the conversion rate comes down a bit, but it's all part of the fun. But basically get as high as you can is the trick there. So that's sales efficiency. On a marketing theme as well, the third one I would look at would be acquisition cost. What is it costing you to essentially buy or get a client, get a customer? And that's the marketing and sales cost. Let's say you're spending $1,000 on marketing and you get 10 new clients a month or a quarter from it, whatever it's going to be. Well, therefore, that's costing you 100 euros, dollars to buy a client. Now, a lot of people don't measure this, but of course, if your margins are tight, your gross profit, your GP is tight. Remember, marketing tends to be an overhead. It gets lost in your overheads. So you may think, we've got a great high gross profit, GP gross margin business. That's all good, but you're spending a fortune on marketing, which is overheads. It will really deplete your net margin, net profitability. If you're only making $150 profit from an order and it's costing you $100 to get that client, you're going to be out of business real quick. So acquisition cost is a very good measure of the efficiency of your marketing team, your marketing department, whatever it is you're doing. When I look at what's it cost us to get a client, I think it's not precise. I think it costs me around about $200, 200 euros to get a client. And the $200 is made up of web, social media marketing, AdWords, pay-per-click, maybe we do an event or a workshop, whatever it is, put it all together. Overall, all our marketing expense delivers into us a number of clients. Each client costs us around about 200 euros. Now, for what we do, that's okay, because if we get a client to do a series of workshops or conference gigs or something like that, our average value of order is high. So therefore, $200, 200 euros, it's absolutely fine. Do I want to get it lower than that? Absolutely, because that comes straight out of profit, but I can live with it, basically. And when you look at your marketing, if you don't measure it now, I do recommend it. Have a look at it. It doesn't have to be perfect, but have a look. What's it costing you to buy a new client? Because that cost comes out of your profitability. And if it's high or higher than you think, then there's a great KPI. Give it to your marketing team. If anybody's here from in marketing, then great. But my apologies for my next statement. What I've done with a number of marketing teams is say, look, you've got zero cash to spend. You've got zero budget. Go and get me some leads and inquiries. And they have to be really creative, because if you're not very careful, marketing teams typically will not sit back, but they'll do pay-per-click, social media, Facebook paid advertising, Google ads, whatever it is. They'll spend money and money and money, and then you're not quite sure what's coming in. Give them zero budget, and they've got to be really creative. Then they've got to go down the route of finding something different, unique, and special to attract people in. In the marketing we do, I do no social media ad campaigns, for example. I don't bother doing it at all. Yes, I would. Yeah, sorry. Yeah, great question. Yes, I would include the salaries into the cost of the sales and marketing team, and the cost of any freelancers that are out there as well, because the only reason they exist is to get leads and inquiries coming through. What I find sometimes when I speak to marketing people or the marketing team, and I say, what is the reason you guys and gals exist? What is the purpose of the marketing department? And they'll say things like visibility, to keep the website fresh and updated, and to raise awareness of our brand. Well, for most of us, I think most of us, certainly in the smaller business sector, we don't have a brand. We have reputation. We don't have a brand. The only reason I'm hiring a salesperson is not for visibility, is not for reputation. It's for inquiries. I just want inquiries to come in. So for that reason, I think that I would include the salaries and the on costs into the marketing team and freelance as well. Yeah, I'd do it. And that might be a bit of a shock to the system when you look at it, how many, because where do your clients come from? That they come through from a referral, a client says, you've got to speak to these guys. They're great. Away you go. They cost you nothing, zero. So you can even lift those out because your marketing department didn't really generate that. That's your reputation and your goodwill paying through. What came through directly as a consequence of marketing activity? What did it cost you? What's the cost per inquiry or the cost per new customer? So yeah, I recommend it. Yeah, but I put the costs in there, and then you can see what it's really costing you to get the sales and marketing team working. Okay, acquisition cost. Next one, number 4, is attrition rate. How long are you keeping clients for? Because one thing getting new customers and clients coming through the door, but if you're not keeping them, it becomes just a conveyor belt, a very expensive conveyor belt. And how you measure that would be, for example, let's say in a year you lose 25 clients. Now, this can be difficult to measure because, if you've got some clients who buy from you this year and then they go away, let's say they're buying a car, you buy a car. Well, if I buy a car this year, I'm unlikely to buy one next year as well. Doesn't mean they've lost me as a client. Just means I'm not going to buy a car this year. So it depends on the business that you're in of how you actually measure this, but we'll go for a 12-month one. So over 12 months, we lost 25 clients. And we had 250 clients overall. Therefore, I'm losing 10% of my clients every year or every month or every period of time. How this shows up, for example, I'll pick on the martial artists again. This is because it's easy to demonstrate. Let's say a martial arts academy had 250 students. They lose some every month. They will lose some students. They go to college or university or leave or whatever it is. And they have this attrition rate. Now in the UK overall, just out of interest, the average attrition rate of a martial arts academy is around about 8%. So an academy will lose 8% of their students, not every year, but every month. So 8% leave every month. Now, if you think about that, 8% a month, 8 12 is 96 over a year, pretty much, not quite accurate, but pretty much you're going to lose your whole business. So if your attrition rate is 8% a month, you're rebuilding your business from scratch every 12 months. Hugely expensive and hugely inefficient. So one of the things we focus on is how can we get that attrition rate down? And we've got clients out there now with an attrition rate of 1.5% to 2% a month. Much more beneficial. They're getting people coming at the top, and they're keeping them. Much more profitable and much more growth coming through. So look at your attrition rate. How many clients are you losing? Now, if you've got a long-term business like the car dealers, for example, rather than looking at number of purchases or attrition rate, look at the space between purchases. Maybe I buy a new car every, 3 years, I suppose, 4 years on average, whatever it is. So if you're selling cars to me, then you want to be watching me. If I'm not around next year, I'll buy a car now. In a couple of years' time, I want to be talking about, new models, new offers, new things, whatever offers and deals to get me to come back to buy a car again and make me a client of that dealer again. So it depends on your business model. You can get a very, very short term, like the martial artists, where it's monthly. Maybe it's I look at it over a 12-month period. Most of our clients are coaching clients. They're with us for, on average, about 3 years. So that's okay for us. We know that's a good mix. We don't lose many clients as we go along. That starts to reduce a little bit. I need to look at it. What am I doing in terms of the value proposition, how the customer service is being built? Do we need to adapt to change what we do? But attrition rate, a key driver. It's very expensive if you're not measuring it, not managing it properly. So attrition rate is number 4. What I also look at, and again, it depends on your business, and I'll send this document across. It's called order intake. So what I would do here, don't worry about the detail of the spreadsheet too much. It's very confusing on a screen. I'm not going to try and bamboozle you with numbers and that sort of thing. But what I would do, let's say I had a booking come in for a series of conferences over in the UK. It's going to be 4 sets of 2 days. April, July, September, November, and that's got a certain value to it. So I would put that in to my order intake. I haven't invoiced it yet, but I know it's in my stock room, if you like. So I put that into my order intake. X dollars goes in there, and I can look at it, and provided my order intake is strong enough, I know then at some point that'll transfer into a sales figure, and the profit and loss account will be strong, and I'll be okay. So order intake is a way of predicting what your P&L will look like in the future. We had a conference booking come through in 2019, for example, for, I think, what was it for? I think it was for about €3,000, and we're delivering it in next month in March. So I've forgotten about it by now. We haven't been paid for it, but it's in my order intake. So I knew in 2019, I've got a future order coming through. It goes into the bank, if you like, and providing that stays very high or high enough, I can predict my future sales based on the quality and the value and the number of orders that are coming in. This little spreadsheet thing, all you do, you fill in. It's self-explanatory. You fill it in when you get an order, you put it in, and it just tells you what you should be bringing in each month, each week, and how you're doing compared to that target. So we do use this, and we get a new booking, a new client, a new whatever it is, we put it in there, and it future predicts how we're doing. It's really interesting because during COVID, I think the 2 years during COVID, our business did okay. We didn't dip particularly. What did happen though, the visibility, the future visibility dropped dramatically because people weren't committing, they weren't forward booking very far into the future, much more short term. So the business in terms of sales was fine, but I didn't have a big order book. Sarah and I were speaking just before we got onto this call, and I'm literally this week, as the COVID restrictions begin to ease in the UK and Luxembourg, we're literally seeing the workshop inquiries are coming in now. Can we do a workshop in Luxembourg in 6 months' time? Wow, great. Then good. Then we can go into put it into the order book, onto the order intake system, gives us visibility. And also that affects then what do we need to do marketing wise? If my future order book starts to drop, I need to start marketing now, not when my sales drop. And it gives that indicator of, in my business, it's around about 4 months from first point of contact to order being received, if you like. So if I want to make my July and August busy months for me, I've got to start marketing now, but my order intake will tell me how I'm doing, and it gives us that nice indicator. Luckily, it's growing now. It is good. Been difficult over the last couple of years for obvious reasons, and maybe for you in your businesses as well. But this gives you a future order book, a future KPI to look at. It's called a leading indicator. The problem I find with P&L, with cash flow forecasts or statements and balance sheets, they're always backward looking. Your profit and loss account tells you what you did last month, last week, last quarter. It's interesting, and you can adjust, you can make changes about it, but really what we want to look at is predictive leading indicators like order intake, for example, like conversion rate. These are leading indicators. If your conversion rate is good, your acquisition cost is good, your marketing is working, your order intake is strong, your P&L will look after itself when you get there. So in all the financials that you're looking at in your business, be careful of only looking backwards. Accountants love this. They do look backwards. Good ones, if you get a good accountant, they should look forwards and predict where you're going to be in the future as well. So I want to have as many leading indicators as I can, because it gives that prediction of the future. And again, I have one of these on my screen all the time. It's not perfect. It's not, it's not perfect. It's an indicator. That's also order intake is a key one. Now, what I find it comes down to pricing is another one to watch out for. It depends how you price, how do you price your products and services. When we first came to Luxembourg, which was, gosh, about 12 years ago now, I had no clue. What do you charge for a workshop in Luxembourg, or a coaching program, or whatever it is? What do you charge for these things? So we just put in a price, that we got the order, and every inquiry we got, we put the price up by 10% until people started saying no. Not the best way of doing it, but still. But people do confuse markup and margin. Just watch out for this. The rule is that your accounts, your P&L, your account system will measure margin, doesn't measure markup. You price markup wise, and I'll explain that in a second or two, but the accounts measure margin, not markup. I've seen a number of times people get tripped up by this, where they're pricing one way, but the accounts are measuring or delivering stats another way around. And I've done this if you're selling a product or a service to a degree, but a product, a widget, whatever you want to call it, you're buying it for this, you're selling it for that, you're likely going to be pricing it on markup, but your accounts will reflect margin. You have to relate between the two. Little tip there, the tighter your margins are, or the lower your markup, the closer margin and markup tend to converge together. So I'll explain that in a second or two. So if you've got in a tight margin business, markup and margin may look the same. It can still trip you up. High markup, and I'll show you in a second or two, it moves away from it. So here we go. This thing on the screen, this whatever it is, looks like a cooling fan unit or something like that. Let's say you buy that for $1,000. You buy that in your company for $1,000 and you price it by, we'll stick on 50%, we mark it by 50%, and there we'll sell it for $1,500. There you go. That's your sales price. Cost price, markup 50%, sales price $1,500. But what's the margin? When you look at your profit and loss account, the sales minus cost of sales, so your sales is 1,500 minus your cost price, your cost of goods sold, your direct costs minus 1,000, it's still $500, but it's not 50%, because what it measures is margin, not markup. And here's the rule: markup is the profit expressed as a percentage of the cost. Margin is the same profit, but expressed as a percentage of the sales price. So that one, the margin is 33%. I'm going to pause there for a second, because this tends to be, people go, wow, I don't get it. But what it is, you're making $500 on that, 1,500, and that profit as a percentage of sales price is a third, 33%. As a percentage of cost price is 50%. So markup, 50%, margin is 33%. And this is where it gets really confusing, because I've sat in meetings with people where they go, we're putting on 50%, 50% profit onto the job. Our accounts are only showing us 33% margin. Where's it going wrong? What's happened? It's all gone wrong. It hasn't gone wrong. It's absolutely fine. Just about to interpret the difference between 50% markup, which isn't in the accounts, and the margin, which is. Now imagine when I said about that they converge. If it was, let's say you put 10% markup on something, to 1,000 becomes 1,100. Well, then the margin is 100 of out of 1,100 as sales price. So it's about 9%, I think. So at tight margins and low markups, markup and margin tend to converge. The higher, the bigger markup, bigger margins, they tend to converge. But even so, they are different all the way through. So just watch out for it. I've seen this happen a lot, where people will say to their the commercial team, we want to make 50% margin on this. And what the commercial team do is they add 50% markup. Doesn't work. Obviously it doesn't work. So just be real careful of how you interpret these two, because it does get people confused. It is very simple, as you can see, but just make sure you're measuring the right things. When you look at what should you mark up by to do a product, it depends on all sorts of things. But you have a pricing policy, pricing process. The challenge I find with markup, for example, it's based on the cost of the product that you buy. So if that product goes up by 100 euros, your price is going to go up by 100 plus 50. You're going to add a margin onto it, sorry, markup onto it, which is okay. But if you value price things, your clients and my clients don't care what it costs me to buy that thing. They don't care my cost price. What they care about is the sale price and the value they derive from it. So why should I price my products based on the cost price? I should base them on perceived added value to my clients. And that's this value pricing model. And certainly if you're in the service sector, for example, in accounting or lawyering or whatever it is, there's a big move towards value pricing. Because if, let's say you've got a bookkeeper and they're earning, I don't know, $10 an hour. Let's just go $10 an hour, and you charge them out at 20 an hour. Well, great. You're going to make 50% margin on that. That's all very, very good. But maybe you can charge more than that. If the value of the proposition is higher, be careful of basing your price on your cost. Your clients don't care about the cost. They care about the value. They care about the value proposition in between. So just when it comes down to pricing policy, be careful around that. For example, if I go and do a workshop somewhere, I'm the cost of going delivering the workshop. Well, what's my time worth? How much do I mark myself up by? It's a tricky question. Anyway, cost price, watch out for markup and margin. They are different. And then you can guide through to your pricing policies. Any questions so far? I just got quite a bit of ground. Any questions? Is it all making sense? Just give me a yes or a thumbs up or something. If not, any questions are fine as well. I'm going to have a quick drink of water. If not, we're going to blast on. We'll take a break in another about 20 minutes so you can go and grab a coffee and that sort of thing. Catch your breath a little bit. So number 7, this sounds almost obvious to a certain extent, but make sure you invoice everything you do. We all think we do this. It's obvious we invoice for what we do, but actually a lot of companies don't. When I go meet with people, look at their business, one of the questions I ask is, well, show me your invoice, show me your sales ledger. Has every job you've done, every product you've shipped, or whatever it is, have they all been invoiced? And they go, yeah, of course it has. Yeah, of course we invoice everything. No, I bet it's not. I guarantee there are gaps in your sales ledger. It's worth having a look. I went to see 2 ladies running a company over in the UK. It was a big marketing company. They would do events and conferences for big pharmaceutical companies. And they've been running the company for quite some time. And they called me. I came through LinkedIn, I think it was years ago. And they said, can we have a conversation? The business seems to be very, very good, but we've got no money. We've got no cash. Can you come and help us out? So, okay, went to meet with them. I was sat talking to, I think it was Claire here, and she was going, look, we've got big clients, AstraZeneca, the big pharma company, doing these great conferences, all very, very good. But we're literally running up on overdraft. Our credit cards are maxed out, and everything's gone horribly wrong. It looks horrible. No idea why. I said, okay, well, what did you sell? What did you invoice during Q1? Let's have a look at that first. Look at the invoice value first. And she called over to Helen, who was a partner, business partner over here, and she said, Helen, could you let what do we invoice in Q1? And this was a classic conversation, but it was true. Helen looked at Claire and she said, I thought you were doing that. I haven't done any invoicing this quarter. And Claire said, well, I haven't done it either. So what had happened was they both thought they were doing the invoicing. No invoices have been raised. No invoice has been raised for 3 months. And guess why there was no cash in the business? Because they got it all wrong around the necks. So invoicing, it sounds very obvious, it sounds very simple, whether you're using Sage or QuickBooks or Xero or whatever system you use. These computer systems, software packages will only invoice what you tell them to invoice. They're not, they're not AI. They're clever, they're good, but you've got to tell them what to invoice. This comes down to your sales ledgers, this type of thing. But have a check. Look at your sales ledger. Are you invoicing everything? Most companies don't. I just say that most companies don't. There are gaps in there. A job's been done, it's been forgotten about, it's been invoiced incorrectly or sent off to the wrong address. It's been sent to the head office, not the billing office or the payments branch, something like this. Do an audit of your invoicing. And what we do, because we're delivering events and workshops and programs all over the place, we have a list of all our events and workshops we've delivered for the month, and we also then tick them all off. Has everybody paid or been invoiced for what we're doing? And regularly we'll find, oh, we didn't invoice that one, whatever it was. We found one. We did a conference for a company in Luxembourg last year, and we found it when we did the check in January. And they were great. They said, look, we haven't invoiced for this one. Can we tuck it in? They were fine. And what it was, they hadn't sent us an official order for it. But so therefore we couldn't raise the invoice, all this sort of thing. It was an admin function. They were very sorry. We were sorry as well. But you've got to check these things. If we hadn't checked it, we wouldn't have found it, and we wouldn't have invoiced for it. So I recommend it. Just have a look at your invoice. Make sure you invoice everything. It's a common one. It's a nice one to find as well. If you find in your sales ledger you've got a couple of grand you haven't invoiced somewhere, well, that's great. Make sure that your clients are okay to pay it as well. What clients don't like, by the way, is if you say, oh, I didn't invoice you 6 months ago, here's the invoice. Well, they don't like it because they've spent the money already. Bit of a shock to the system. When we went back to the big pharma guys, we did a bit of a deal for them. They were fine, they were okay, but it does, if you're not invoicing properly, it does make you wonder what's happening elsewhere in the business in terms of customer service and this type of thing. It's one of the key drivers. So get control of your sales ledger and make sure that you're invoicing everybody. Same thing goes for the purchase ledger. One of the things that we do, and there's a good rule, I think, and we've done this in business for forever since we started donkeys years ago. If we receive an invoice and it's approved and we agree it, we pay it immediately. We don't go for this 30, 60, 90 days. We pay it immediately, get it out of the way. Make sure you're paying your suppliers as well, because they can be really helpful to you. You need your suppliers, so support you, guide you, help you through all this sort of thing. We pay everybody. Even now, we pay them, let's say within 5 days, we pay them, just because we don't want it hanging around. If you're not paying your suppliers, then that will show up to people. Maybe is your cash flow under control? If you're looking after people properly, this is an interesting sort of acid test, if you like. And we're going to look at debtor days and creditor days later on too. Simply number 7, raise every invoice you do and make sure you send it, and then make sure you collect it as well. We'll touch on that a bit later on. So number 8 is your direct costs. Now this is the costs associated with the delivery of the service or the product or the good that you're doing. It could be people, it could be components, it could be raw materials. It doesn't matter what it is, but what are your real direct costs? Do you measure them? Do you know them? Because what I find a lot is that there's costs associated with the delivery of the product, the good. Really, they're down as an overhead as well. They shouldn't be an overhead. We want to be realistic about what is a direct cost and what is an overhead. On average, I find a lot of people, they don't really book the right cost to direct costs, or they appear as overheads. Now, it depends on what business you're in. We ran a transport company that had a fleet of trucks, for example. Now, if I'm running a transport company, the cost of those vehicles, the fuel, the vehicle, the drivers, the insurance, everything that goes with that vehicle is a direct cost. It goes towards the delivery of the product. When I was running a case making business, making packing cases for engines for aircraft, for example, the transport that we didn't have any vehicles. We would sub out, we charged extra for it, whatever, but the client would come and collect the products from. We didn't have any vehicles, so my transport costs weren't a direct cost, whereas when I was a transport company, they were. So it depends on what business you're in, but be really clear what becomes a direct cost and what becomes an overhead, and that will dictate then your gross profitability. So we look at gross profit, we see is sales minus direct costs equals gross profit. If you're not invoicing everything, then your sales will be down. But if your direct costs aren't appropriate, or you're not measuring them or apportioning them to the jobs that you're doing, your gross profit won't be accurate either. And so measure it. That's the key thing. Get a control of that gross profit. I go for gross profit more than net profit, actually, as a measure, because it drives everything else. If my gross profit is good and strong and holding up, well, everything else will be as well. But I want to make sure I've got everything in there, everything put in as a direct cost. Now, from an accounting point of view, it may be that you've got, some costs might be split. Maybe have something as a direct cost and it's an overhead as well. Maybe there's one person that does some work on the factory floor and they do some work in the office as well. That doesn't matter. Just make sure you split it out the right way, but make sure you're accruing and gathering all your direct costs together. So 10,000 in sales, direct costs 4,000 gives you a gross profit of 6,000, but make sure it's a clean figure. On terms of sales, we look at your P&L. If I'm invoicing and it includes TVA, VAT, that's not a sale. I'm just collecting the sales tax. I'm collecting it for the government. So the sales volume that I'm looking at does not include VAT. So the sales is a net figure, if you like, net of tax, sales tax, and my costs are net as well. So if I'm buying materials or things in, then that includes TVA, VAT, sales tax, whatever it is. Those come out. and I'm measuring these net figures. So direct costs without VAT and sales without VAT gives me a gross profit percentage. And then sales tax is something we just pay, pay to the government. We're paid or unpaid tax collectors for our governments, basically. We all have to do it, but there we go. So again, manage your gross profits. It is the key driver of the business. Be sure your direct costs are clean. You understand them, what goes into them, what goes out of them, and what is your sales figure. Make sure you invoice everything. Again, I'll have a little sort of side bet with you. If you look at your sales ledger, there's going to be something in there that either hasn't been invoiced or maybe hasn't been paid, but been sent to the wrong address. And it doesn't have to be a lot, but of course, if you don't invoice something, by definition, that comes off your profit, straight off your net profit. It's just out there. You can lose your profitability straight away by not invoicing a couple of big jobs. So I recommend that as a bit of housekeeping or a target for your accountant. If you're not an accountant, but you have an accountant working with you, ask them, show me. It's a great term to say, show me. Prove to me every job we've done has been invoiced. And they're going to go, no, well, of course you've been invoiced. You've got sales ledger reports, you've got this and this. Show me. And they're going to find some gaps. It's an interesting one to look at. So you might find some spare cash lying around your business as well there. So number 9, gross profits. Have a look at that one. And then obviously gross margin is the rate of the percentage that you're making as well. This when it comes down to the pricing and your discounting. Gross profit over sales times 100%. So 6,000 divided by 10,000 gives you 60%. So what should your gross margin be? Well, it should be consistent. That's what it should be. If you put your prices up, for example, if you get raw materials increase or direct costs increase, you should be looking at your pricing to get that, maintain your gross margins. Don't sacrifice your gross margin percentage. When was the last time you put your prices up? And it's a general question. When was the last time you put your prices up? I was with a martial artist two months ago on a call. He said we hadn't put our prices up for 5 years. It's like, crikey, 5 years. Well, inflation's gone up, costs have gone up. And what he thought he was doing okay with it was because he grew his business. He got more students than he had before. But of course, the margin wasn't strong enough. So he was just running faster to stand still. Put your prices up a little bit. You put your prices up by 5%, nobody's going to realize. Nobody's going to know. You can probably get away with 10% and nobody's going to know about it as well. Once you start to creep a bit from that, clients will recognize it and may question you on it, but keep putting your prices up. And if you haven't put your prices up for the last couple of years, now's the time. Do it gently, make sure the value's there, but put your prices up. Maintain your gross margin. It's a key driver in the business for profitability. And why is profitability key? Well, because if you own the business, you get your dividends, you get paid, as I do, you don't get paid out of sales and profit, you get paid out of retained profit on the balance sheet. So it comes down to dividend payments as well. And of course, you've got to pay corporation tax as well there. So gross profit, make sure you're maintaining that, grow it wherever you can. I don't know what the gross profit percentage should be in your sector. It depends what it's going to be. One of the things you can do, of course, here is look at what your competitors are doing. If you can, get a hold of their gross profits, GP percentage, and you should be at least as good as they are, if not higher. It's a key driver for sales teams as well. If you're running a sales team, they will tend to discount to get the order. That hits your gross profit straight away. Don't discount, or at least don't give away your margin. If you want to give incentives, so volume incentives, this type of thing, that can be okay. But even volume incentive discounts, they can be hugely expensive because you give away 10% price reduction that goes straight through, knocks off your gross profit. For example, if you're making 10% net profit in your business and you give 10% discount at the top end, you've lost all your profit. That's it, gone. People confuse gross and net. So maintain your gross profitability. Don't give it away. Don't discount wherever you can. Again, for your team, learn how to sell, learn how to negotiate, and learn how to build value in the chain. But watch out for losing your gross margins. Okay, any questions on that one? That's again, these stats tend to sort of lose people a little bit if we're not careful. But any questions, just please type them in. Number 11 is efficiency. Now, this again, another key driver here is the time actually worked over the hours available. Let's say that somebody in your company is actually working 20 hours. And what I mean by work is billable work, productive work, work that adds to the business, not wandering around drinking coffee, having meetings or chatting or going to the restroom or whatever it is, having lunch, whatever, all that sort of thing. That's not work. That's called attendance. Work is different. So if they're working 20 hours, but they're in your business for 40 hours a week, the efficiency is 50%. And it's been shown that actually most people in a workplace are only working 3 hours a day. And I mean, physical, productive work, 3 hours a day, 4 hours a day. Other time is spent, wandering around, chatting, talking, whatever. They're not physically producing anything. Now, nobody's going to be 100%. You can't have somebody working 40 hours a week and that every hour is productive work, because they're going to get burned out. It can't be done. But if it's down at sort of 50% or lower, when you measure it, there's definitely something you can do there, because this would show up as reduction in your margin or increase in your costs, and you can measure it. For me, for example, I know I'm easy to measure because I spend a lot of my time delivering a workshop like this via Zoom for you guys. So these are 3 hours, highly productive. I've got 2 coaching calls later on this afternoon after this is done, one with my client in Canada. Like I say, how many hours today have I been productive for? So there's this workshop, a couple of client calls. There was a couple of client calls this morning over the day. But in between these events and my client calls, what am I doing? Is it productive work? So my efficiency is reasonably high, but even for what I do, it's only about 60%. Because I've got to I'll do some social media stuff and marketing activity. I've got to go and let the dog out, as you heard, or whatever it is. There's things I do that aren't productive in the business. So I try and get my efficiency up. But for you and your teams, have a look at it. Again, this is one of those things you're going to be quite surprised when you look at people, how much work, added value work are they doing? And how much added value work do you do? And then not for me to question you on it, but it's probably going to be lower than you think. If you've come across, there's a fabulous book called The 4-Day Week. Have you come across it, where an organization is in New Zealand, and the CEO went to the board and said, look, I want to improve the efficiency of the company by getting people to be more productive, do more with the time they've got. And he said, what we're going to do, we're going to make them work 4 days a week, not 5. A guy is called Andrew Barnes. You can Google Andrew Barnes 4-Day Week. Lots of materials around there for this one. And they said, okay, well, you work 4 days a week. We'll pay you for 5. But you work 4 days, not 4 long days, 4 days of 8 hours, and in that time, though, you can have Friday off or Monday morning, Tuesday afternoon, whatever it is, have the time away from home, do 4 days a week, but we want the same level of output. We want the same level of work doing in the 4 days you were here than you used to do in the 5 days. And of course, this was a big risk because the board said, "We're mad. These people are busy already. They're already doing things. They're already fully stretched." He said, "Well, I think we can do more." And this is one of the challenges. If I said to you, "Are you busy?" You're going to go, "Yeah, I'm busy. I'm absolutely flat out, busy, working long hours, weekends, evenings, emails, this sort of thing." And if I said to you, "Well, can you do it in 1 day a week less?" You'd think I was insane. It's ridiculous. Of course not. We're busy. And it's a pattern we fall into, but also a pattern you may fall into with your teams as well, where they become a habit of being busy. And guess where they get it from? They copy us as managers and leaders. If you're busy, guess what your team are going to be? I've never seen a team in the world where the manager is busy, doing all these sort of crazy hours and things like that, and the team are just sat back, filing the nails or wandering off and having an afternoon break. It doesn't work that way. They copy us as managers and leaders. So what they did over in New Zealand was they introduced this 4-day week, and what they found was that productivity, or the output, actually went up. People were doing more in 4 days a week than they were doing in 5, which sounds totally counterintuitive. How does that work? Does it mean people were lazy before? No, not at all. It doesn't mean they were lazy. It means they were filling the time they were given. And this is one of the challenges, I think, with work. Work fills the time we choose to give to it. So give work less time and you'll become more efficient. You just will. We run our company's 3 days a week, Monday, Tuesday, Wednesday. And that means on Thursdays and Fridays, we are either traveling, renovating this French cottage we've moved into, or I can deliver workshops like this, which is obviously a pleasure, but I've got time. I've got a client meeting this afternoon over, he's in Canada, so he couldn't make during the week. I've got flexibility, but I want to run my business 3 days a week. If I gave it 5 days a week, the work that I've got, I could make it work, stretch over to 5 days, guaranteed I could, but I don't. I'm very regimented with my diary, or Lynn, my wife is, she manages my diary for me, thank goodness. So with your team, how efficient are they? Are they working, added value? Are they working for how many hours a day or a week? And I'm not suggesting you go to the 4-day week, but it's a mindset thing. Really interesting. You probably find people are inefficient. Let's have a look. Thank you for the question. Do you have any feedbacks on 35 hours work week or 4-day work week in terms of efficiency? Does it increase? I think it increases. No, I think it increases. The similar thing to the Japanese experiment. I think what they found was, when they went from the 5 days to 4 days, for example, that people, they valued having that time away, and it gave them more motivation to get stuff done. And if you think, I think how it works is, if you imagine, what's the most productive day of the year for all of us? It's probably the day before we go on holiday, because if we've got to get to the airport for 7 o'clock or whatever it is, we get stuff done, emails out, do this, do that, scrap that, do this. We're highly productive when we've got a real motivation to be highly productive. And I think that's what happened with the 4-day week, where people could choose to have a Monday off or a Friday off or whatever it was in between, and then negotiated between themselves. What they found was, when it enabled them to improve their lifestyle, have time with family or travel or whatever it was, that they were more motivated, and they got stuff done, basically. So I think it was more to do with the motivation and the valuing of their own time, but working 3 days, so working 4 days and having 3 days off every week, such a big motivator. They were just, as a goal, they got more stuff done. So they did it. Specifically on the 35-hour work week, I would anticipate the same sort of thing happening. If it's 7 hours a day, it's still only going to be 3.5 hours a day people are actually productive for, and they won't think they are, but they are actually. Everybody says they're busy. People say, yeah, I'm busy, I can't talk to you now, I'm up to my neck in it, and all this sort of thing. And they are. It may do, yeah. Motivation may fade eventually. This is what happened with the 4-day week. What they did was they put an academic study on it, because they were concerned about this. Will it die back, and will productivity or efficiency drop on the 4 days, and you're down to 3 days then, or something like that? I believe the evidence is showing the moment it hasn't. It's been running for a couple of years, and the efficiency has kept up, the motivation has kept going. What it's also done, just out of interest, is it's made it a very attractive place to work. When it comes to hiring people, recruiting people, they have a waiting list now, I think, as well. So some other added value benefits there. But yeah, it's a good point. Motivation may fade over time. I don't know what time scale that would be. So far, I don't think it has, or the numbers would suggest it hasn't. There's been a couple of universities studying this experiment they did down there with Perpetual Guardian was the company, and so far so good. And what I'm seeing now certainly in the UK and in Luxembourg as well, big companies are now saying, with COVID, we're going to work from home. Great, but let's go for a 4-day week. Let's see how it works. Let's take the risk of working 4 days and having a higher value of production out there. I think you may be right. I do wonder, after 5 years, will it sort of swing back to being more normal? I don't know, but certainly short term, or to date, it's been shown to be more productive and more efficient, and a more happier workforce as well. I suppose that's one of the things to go. But certainly from a recruitment perspective and uniqueness and a competitive advantage out in the marketplace and visibility, it's really paid dividends for them. But I think time will tell. Time will tell. But even if you don't do the 4-day week, certainly measure efficiency. How can you get people to do more in the time they've got? And this comes down to leadership. It comes to motivation, not just paying them more money. Not just that. It could be rewards or recognition, just saying thank you to people, whatever it is. But anyway, but there are things you can do, but measure the efficiency so you can manage it. Is a key. But yeah, great question. But we'll wonder about that motivation dropping off. I don't know. Number 12. oops, here we go, is then is productivity. So with the hours that you are physically working, what is your level of output? You're doing 20 hours a week, and what are you producing with that? So you're 100 units in 20 hours, you're doing 5 units per hour, for example. Well, that's a key. Now, difficult to measure, especially in the service business sector. If you're in sort of consulting, service provision, whatever it is, how do you do that? How do you measure what the output's going to be? It can be quite challenging. If you're in a factory, producing widgets or washers or nuts and bolts, dead easy to manage. More challenging for me as well. How do I measure my output? Because I am with you on a workshop, I'm with clients, maybe more difficult to challenge, but in certain sectors, it can be that productivity can be a key driver as well. There's one thing working, but how, not the speed, but rate of work and quality of work as well. There's an interesting case study being done over a company called Morningstar over in the US, in California. And I'll just send a link across with the note if that's okay. But they use a principle of high productivity by having no hierarchy in the business. There's no bosses in Morningstar, and they all just negotiate with each other to do a great job and this sort of thing. But their productivity is extremely high in terms of the throughput. They're a tomato processing company, the biggest in the US, I think now, and they put the productivity is very, very high because people are motivated. They negotiate with each other. They avoid working in these silos and this sort of thing. Everybody talks and communications high, productivity goes up. So there are certain situations where productivity can be measured. Not so easy in other situations, maybe, but if you can measure it, be really clear about it, and how can you improve that level of productivity? Because high productivity equals higher gross margin, likely, and reduces down cost of overheads as well. So productivity, I recommend it. Depends on what sector you're in. And then finally, for this sector, for this first half, if you like, is sounds obvious, but overheads. Measure your overheads. Overheads is anything that is not a direct cost. By definition, is an overhead, because it used to be the factories used to be on the shop floor, offices above, if you like. It was on the shop floor, it was overhead, therefore it's a cost. But look at your overhead schedule. Look at your overheads. What are you spending money on? And I find this a lot again with the client work that I do. Show me your overhead schedule. Show me your ledgers where you've got costs for your insurance and things like that. And there's always something in there that is a surprise. Why are you paying that? There's a subscription we're doing here. We've got this, we've got that. And you can probably do quite a bit of work on your overheads, not to reduce the overheads, but there might be things in there that you're paying that you shouldn't be paying. Are things going out of your bank account that shouldn't be going out of your bank account, for example? There's a trial done in the UK, actually. I thought it was very clever. A guy went to see the CEO of a company. He said, look, I can save you money in your business because your business is inherently inefficient. And the guy said, no, we're good, we're fine. He said, look, what I'm going to do, he told him what he was going to do. So don't try this, okay? So what I'm going to do, I'm going to raise some invoices on your company, and they're going to get paid and for no services offered. So the guy said, well, okay, did it all above board. So what he did, he knew that in this company, the any invoice under £100 value was just so small, it just got paid. Your invoice comes in, cleared, get paid, and away you go. So every day for a month, this guy raised an invoice for £75, £85, £90, went in, and then waited for a while, and they all got paid. He went back to see him. He said, look, here's it was quite a lot of money, and he didn't keep the money. It was all done properly, get the money back, and this sort of thing. What it demonstrated was inefficiencies or lack of control in overheads. And I'm not suggesting that would happen in your business particularly, but is somebody invoicing you for things you haven't bought, or have you got subscriptions that were signed up for years ago they're not now using? Are the things in your overhead schedule on your accounts that really shouldn't be there? So just check. It's worth doing a bit of housekeeping and just make sure your overheads are efficient and effective. And can you get your overheads down by 10%? If you can, well then great. I don't mean go and fire people, but can you look at your overheads and can you do it in a better way? Can you use freelancers? Can you outsource things? What can you do to reduce your overhead spend? It's a great way of monitoring and managing. Now, overheads will improve not your gross margin, because overheads are not associated with the delivery of the product or service, but it'll certainly improve your net margin because these overheads aren't being charged back up the line again. So it's worth doing it. Again, in my experience, these things tend to get missed or glossed over, or because it's in the budget, we spend it and all this sort of thing. I recommend it. So just check on your overhead schedule, make sure it's all legitimate, you're happy with it. Are things being authorized properly in your business? Okay, so we're about sort of halfway ish now. So any questions before we go for a break? Any questions, please just type anything in. Is it making sense? That's the fact. Is it making sense? We're covering quite a bit of ground. Is it making sense? Just give me a yes or a no. But fabulous. That's the main thing. Good. So are there any questions? Please just type them in. You're welcome to ask anything you like. If not, it's absolutely fine. What I suggest we do is we've been sat here now for nearly an hour and a half. Let's go for a break and have a coffee, and we'll take a 20-minute break. So we'll come back in at quarter to 4, if that's okay. So it's 15:25 now, 20 minutes, grab a coffee, natural break, get some fresh air, check your emails, and I'll pause recording and I'll start again exactly on quarter 2, and we'll go for the second half. Is that okay? 20-minute break. I'll see you at quarter to 4. Fabulous. Thank you, and I'll be back. See you in about 20 minutes. Okay, so welcome to part 2. We are recording again. I assume everybody's back. I hope they are. And I'm going to start off anyway, carrying through. Before I go into the sort of the second half, there's a lot more content to go through. Have you had time to have any thoughts, any questions, anything you'd like me to refresh or go over again or anything like that? Please just type it in and I'll happily divert and go on to it. So I'll keep watching the chat box for now. If not, no worries. I'll just carry on. And as we go along, I look forward to updates. So we covered overheads just before the break. And then one thing to look at is overhead efficiency. So what does that mean? What's this overhead? And there's some ratios and numbers here that I sort of glaze over at some of these sometimes as well. But these are really interesting numbers to look at from a management perspective, managing your business. So if you look at your overheads compared to your gross margin, let's say your overheads are 50,000 and your overheads are, sorry, your gross margin is 100,000, then your efficiency, overhead efficiency is 50%. And it's just an interesting way of looking at how efficient is your business, how efficient is your company. And with all these things, I think the key thing to remember is these can be used to measure things, but also to lead and to motivate and predict as well. So I remember when I would go to board meetings when I was running a wood mill, I was in part of a big group of companies over in the UK, and we'd go to these board meetings or regular management meetings, and all we had to do was go around the table and report a set of numbers, and it would be sales and profit, but also would be key things on productivity, on efficiency, on absenteeism, all this sort of thing. And we had to be managing all these numbers. If we didn't know what was contributing towards them, we would get sort of told off, if you like, or anything like that. We get told off, and it was always quite painful. And I think having control over the business in terms of the numbers, it shows it's a professional management approach. That's all it really is, and it means you can sleep at night as well. What should happen with all these things, just as some separate little bit of an aside, is that really it puts you in control. It means you can sleep at night. You're not going to be worrying about things too much, because having control over the numbers, it really means you can, if something goes wrong or the numbers aren't right, you know how you're going to put it right and correct it. But it gives you that confidence that you can actually sort things out as you go along. So overheads, gross margin, what's the overhead efficiency? And this one, it's 50%. Again, what's good, what's bad, what's right and what's wrong, it depends on your sector, on your particular situation. What you can also do is measure it, look at the accounts from last year, last quarter or something like that, and find a way then with the management team to improve it. It doesn't matter what the number is. Let's say it was 50% in your company or your business. Well, how can you get that better? How can you make it improve it by 2 or 3 percentage points this year? And this also enables us to look to reward people. It's difficult sometimes to reward people if they're not in sales or on bonus or commission on this sort of thing. But actually, when it comes to productivity and efficiency, these are the sort of ratios that you can look at and agree with the team. Look, if you get the ratio to this point by doing whatever you got to do, that's valuable to the organization. We can reward that with recognition or time or money if you have to, but you can incentivize people around these areas to look after it and control it for you. And what I've also found is, as in life and in business as well, whatever we choose to focus on shows up. I don't know if anybody on the call rides a motorbike. Any motorcyclists on the call at all? Doesn't matter, but if you are, then you'll understand this. But when we lived over in the USA, we lived out of Las Vegas, which is a crazy place to live. Don't live there. But I bought a motorbike, and I'd never ridden a bike in my life. I bought a big Harley Davidson. I think it was an 1130cc, massive, great thing. It's ridiculous. Anyway, went on my motorbike test or training, and the guy said to us, when you're riding your bike around this car park, he said, do not look at the central bollard, the big concrete block in the middle where the lights are bolted to, because on a motorbike, whatever you look at, you hit. And he was right. But same in business as well, not that you hit it, but if you look at something, you measure it, it tends to improve. It tends to increase, or tends to improve, or develop and change. I don't know how that happens, but this is why measuring numbers or monitoring numbers is so important, because we should have visibility of these things. And whatever we focus on, we manage it and we can improve it over time. So it gives you that level of control as well. So another ratio for you: overheads, efficiency of overheads is a key one. And then we're back into another one, net profitability. Now we know the total sales minus total costs, direct costs and overheads, equals your net profit. If you're an operations manager or you're running your own business, net profitability is a key driver, because that's the reason we're in business. We have to make a profit, because running profits, at some point we're going to run out of cash, and therefore the business will struggle and sort of shut down again. So net profitability is key. It always amazes me. You speak to people, entrepreneurs, business owners, executives, and when they talk about their companies, they talk about revenue. We're a 5 million business, we're a 20 million business. Well, that's great, but really, I don't care about that. Well, I do care about it, but what we're really interested in, of all that stuff that you're doing, sales and overheads, how much do you keep? And net profit is, how much do you keep? How much is in the net at the end of the day? The catchment. What do you keep? That's the real acid test of a successful company. We're going to talk a little bit later on around break-even points as well, which is another interesting one for net profitability. But anyway, measure it, you can manage it, and what is your net profit? What do you need this year? What do you, because if you own the business, this is where you're going to pay yourself from. You're going to pay yourself out of dividends. And you've got to pay tax on this as well. Of course, this is where your corporation company tax comes from. There's an argument, isn't there, between should you be very tax efficient and have low profitability? Well, maybe, but also if you pay yourself out of from dividends, you're going to have profits after tax to be able to do that as well. I think it's better to have healthy profitability in the business, healthy net profits, because that gives us sustainability. If your profits are very, very thin, very thin net profits, then there's a question there around resilience of the company, and how can you grow it? And if you're an operations manager, your +1, +2 shareholders will expect you to drive this forwards, net profits, and also as a percentage as well. But what are you keeping in the business? What's the net at the end of the year or the quarter? So net profit, I recommend it. It's a fabulous, simple KPI to look at. And predicted as well. When we look at budgets, it's forward casting the business now. You've got your P&L shows you last quarter, last month. Your budget is your prediction for the year. If you've got a real close handle on all your ratios, all these ones we're talking about, when it comes down to predicting the business, then you'll be reasonably accurate. You can predict forwards what the net profit's going to be. I have a client in the UK, a lovely, lovely guy, and he's so accurate with his budgets. He's got all these ratios, and even through COVID, he was within 2 or 3% of sales and profits and this sort of thing. Well, that's incredible, because budgets are just your best guess to a certain extent. But the more information you have, the more understanding of the levers of power and control in your business, such as this, then you'll be much more accurate with your predictions, with your budgets, and with your forecasts as well, which is obviously good from management perspective. So net profit, key driver. Next one, net profit margin. We know about this one's a profitability as a percentage, net profit over sales. So if you're making 10,000 net profit and your sales is 100,000, 10% net profit. Again, remember not to be confused with markup. Markup is the profit expressed as a percentage of cost price. Margin, which the accounts measure, is your profit expressed as a percentage of your sales price, sales value, without sales tax applied to it. Again, net profitability in percentage terms. What tends to happen in a growing business, if you're not very careful, the net profitability on paper, you think you do more sales, more activity at the top end, it should increase. The business should get more efficient. You should get more, but they tend not to, because what happens is, as a business grows, people start to recruit people, put more people into accounts or service and compliance and auditing, and the overheads get very, very bloated if you're not very careful. And this percentage net profitability or net margin, it actually decreases. Whereas actually, with a growing business, it should arguably increase. And if you look at a lot of companies, they'll be very happy with 10% net profitability. I don't think it's good enough. I like to have more than 10% net. If you're in the professional services, for example, then there's some classic ratios out for accounting firms where it's third, for example. Where you have a third direct costs, a third overheads, and a third profitability coming through. So 33% net profit, for example, that's much more like it. There's no reason why you can't do more than 10% net profit. Why not make 50% net profit? And this is always a question, a challenge from a management perspective. And one of the questions I ask people is, the next slide we're going to look at is break-even point, which is dictated to by our gross profits as well. But if your net profits are thin and weak, if you have a bad month, let's say you've got 10% net profits budgeted for in a year, you have one bad month, well, that can wipe out the profit for the whole year if you're not very careful. So be very careful. This sensitivity analysis is a key driver as well. So net profit margin, a key driver. Just letting people back in. Here we go. There we are. And then that leads into break-even point. This is a favorite one of mine. Not many people measure this or understand it to a certain extent. Did anybody here measure your break-even point, just out of interest? Anybody measure or know what their break-even point is in their business? Just quick to type it here. I'll be really impressed if you do. Pleasantly surprised. So anybody, doesn't matter, maybe not. So what is break-even points? Well, imagine this is your gross profit in a year, total gross profit, for example, and there's your overheads. That gap between the two there is your net profit. Might be percentage, but it's net profit. The gap is net profit. Over 12 months, for example, there's a time in the year when you're going to break even. Now, if you're making oh, excellent. Oh, you do. Okay, fabulous. Thank you. What is your break-even point? Out of interest, do you have what's your break? Is it a sales figure? Is it a time in the year or something maybe? But I'll carry on, but I'm interested to see that one as well. Now, if you look at how do you calculate your break-even point? Well, it's 100 minus your net profit percentage multiplied by times sales figure. Great, perfect, good. Thank you. By time gives you break even. Now, what we can look for is absolutely, you've got there a sales figure, what sales we need to hit break even point, but it can be a time in the calendar as well. We do both. I know roughly what we've got to do to hit break even in terms of when have we paid all the overheads in the business, and based on your profitability and your gross profit, you can say, okay, once I've hit this figure, I've paid all my overheads for the year, and that figure could be 1 million, it could be 500,000, it could be 10 million, doesn't matter what it is. But then I hit that figure, everything else we make then, all the gross profit we make then goes straight to the bottom line. That's your break even thing. This one, how it works out would be, let's say net profitability is 10% over 12 months. Break in this business here, based on these numbers, breaks even after 10.8 months. So towards the back end of November. So what it means is they're working all year to the end of November, pretty much. They only make profit in the last 1 month of the year. And to me, that seems a bit thin. It seems a bit sensitive, because if you have a bad month, one bad month, or December's quiet, or COVID kicks off or something like that, then it means you're going to be out of profit. So one of the tips, I think, is to get that break even point earlier in the year, and using the sales figure, get the requirement for sales lower to cover your overheads. Now, you can do that 2 or 3 ways. You can improve your gross profit margin. put your prices up, be more efficient, add more value. For the same level of sales, you get more profit from it. That's a great way of doing it. Get your overheads down. Make sure that you are not spending money where you shouldn't, if you like. Get the overheads under control and increase that gap. My company, I want to break even by the end of September. So it's within the quarter. So that means that I've got 3 quarters of the year. We're working to pay the cost of the overheads, all that sort of thing. The final quarter, 3 months, we've broken even. Everything we make then effectively becomes profitability. I want to get it bigger and better than that, but we're driving towards it. And this can be a good performance indicator, in your business, in your company. What is break-even point? Either a sales figure, because if you can get the sales figure lower to hit break even, then you keep the total sales high, but you break even earlier, you make more profit out of it, if that makes sense. It's a great KPI, great driver. I've got people with companies where they have a KPI, a target, if you like, of breaking even by end of November or end of September or end of July, end of whatever it is. They have a break-even point in the year. In some companies, you can have a break-even point in the month. Or in the week, in the day. Now, if we know what the sales figure is, as you put in there, you're absolutely right. If you know what the sales figure is to get to break even, let's say you've got to get on a daily basis, 50,000 gets you break even. Well, we've got a client in the UK, and what they do is they say, we get to 50,000 or whatever the break even point is, hit break even before lunchtime, and we'll buy you lunch. And then after that, everything is profitability. If you don't hit break even by 12 o'clock, you don't get it. And it's a real motivator for the sales team. They have a big dial on the wall, a big dashboard, where they're in sort of like retail sales, but online sales, this type of thing. And they hit the phones, they're calling, they're doing all the selling. And when that creeps around to, let's call it 50,000 in the morning, hit 50,000, they can order lunch. It might be a pizza, it could be sandwiches, whatever it is. It doesn't cost a huge amount, but it's a real key drive. And what it means is, but in the afternoon, they've got to keep going, but everything they make in the afternoon is clear profit. That break-even point in terms of a sales figure and the timing of that sales figure being hit can be a real good motivator for a sales or commercial team as well. And then you can base it, you can scroll all the way back then and look at the acquisition cost, your conversion rate, all this sort of thing goes into the mix here to hit that magical break-even point. In my experience, a lot of companies break even too late, either in the year or they never hit it if you're not very careful. And this is when profitability really dips. But they don't really measure it, they don't manage it, they certainly don't have KPIs around it. So if you can, for your division, your department, your company, whatever it is, have a figure and work to it, then try and improve it. If it's the sales figure, absolutely, a sales figure is great, providing your margins are held. But of course, if your margins increase, if your gross margins increase, arguably your break-even sales figure will come down a little bit. Not saying you're going to sell less, but it gives you more slack in the system. The break-even point comes down, which means you break even earlier in the week or earlier in the day or earlier in the year. And I'd recommend it by having this sort of efficiency in sales and a KPI dashboard to go with it. It's a great one. Have these numbers on the board somewhere. They can be really quite powerful. So I recommend the break-even point, another really interesting one. Who's using that? I mean, you've got, I'm just interested, Bohan, you've got the, forgive me if I haven't pronounced your name correctly. You've got a sales figure. Do you measure the timing of that as well? Or is it just purely a break-even sales figure? Do you have a timing when you want to hit that? I'm just interested. That's what I'm intrigued. I'm intrigued you've got one. I'm intrigued you know it, which is really good. That's unusual for people to know their break-even point. So well done for that. But do you have a timing against it as well, or just the sales figure? I'll just type in when you're ready. Okay, so break-even point, we've covered that. Now cash flow. Now this is something, again, we mentioned it earlier on the cash flow statements and that sort of thing. This is separate to your profit and loss, separate to your balance sheet and that sort of thing. But it really is a measure of when does cash come into your business and when does it leave the business? And that's what it measures. Because you're on an accounting system, maybe accrual accounting, when you're taking the sale, when the invoice is raised rather than the cash received, for example. If you're in retail, over a store retail, not online sales particularly, but store retail, cash flow is very, very good because you get the cash before they've left the store. For a lot of us, when we're in the B2B sector, when we deliver a product or a service, service. We invoice and then we wait for 60 days or whatever it is sometimes to get paid, which we don't really want to do. But cash flow forecasting gets rid of all that. It's a prediction based on your creditor terms, your payment terms, your debtor days, all this sort of thing, and you're managing your cash. It gives you great control. What it means, as we mentioned earlier on, maybe if you want to get a loan, an overdraft or something like that to fund the business, with this you can be really clear on what you need, why you need it, and how long you're going to need it for, because you can start to trade out of it. Providing you're generating cash flow at the top end and is growing, you can trade through a cash flow dip. I think, as I said before, I've never seen a companies don't close because of lack of sales. They don't. That's never killed a company. They die because of cash flow. Look at Tesla. They're a fabulous example. Look at Tesla. I think they're a great company. Didn't make any money for a long time. They made no profits at all. They were being propped up by investors, by people putting money in the hope they're going to get it back. Now they seem to be turning now, but if they hadn't got cash being put in, they would have gone bankrupt. The bankruptcy is basically an inability to pay your suppliers. Excuse me. If you can't pay your bills, the business goes out. So you need cash. Cash is king. And if you're running out of sales, that's one thing, you can fix that. But if you're running out of cash, that will kill the business really quickly. So I recommend a cash flow forecast. What you should also do is predict it for the year based on your budgets and your throughput, and then measure how's it showing up. Your bank reconciliation. How accurate is your bank account? Have you got the cash that you thought? So, any questions on that? I'm going to have a bit of a cough now, but any questions around cash flow? Because do you have a cash flow forecast, cash flow statement in your business? We could type in a yes or a no, maybe. It gets overlooked by a lot of people. Just type in a yes or a no. I guess a no is a no comment is a no. You've got one. Okay, you do. Excellent. Okay, good. Do you find it helpful? I mean, generally you've got one. Do you find it helpful and useful in terms of managing the business, future visibility, and avoiding, any shocks in your bank account? That's the whole thing for this. It should be a supporting document for you, but have a cash flow forecast. This template I'm showing on here, I'll email it over. You're welcome to use this one. It's very, very basic. If you've got an accounting package or you've got a good accountant, they will guide you through this and they'll show you the templates to do. It's simply a timing thing, source of cash and destination of money coming out of the bank account. So I recommend it anyway, but good that you've got one. Now, how it shows up in terms of cash flow is a thing called the cash gap. And this is a concept, but it shows, let's say, you can see here on the screen, we've got, so I'm looking at the screen over here, we've got inventory. So inventory arrives, stock, product, something arrives in the business, it sits on your shelf, and then after sort of 30 days, this payables here, this 30 days, you pay your supplier. So your cash is left, but you haven't sold the stock yet, it's still sat on the shelf. That stock gets shipped, let's say 60 days, but then you don't get paid for it until here 120 days. And that gap between when you pay for it to when you get paid for it as a product is your cash gap. So on here, we're showing this is 90 days. You're funding cash out there for 90 days. Another way around that, if you can, is pay for your inventory later, stretch this out, get better payment terms from your suppliers, consignment stock or whatever it is. Find a way not to try and screw your suppliers, but see if you can hold the cash in your account first. And then when you sell it quicker. There's a gap here between 30 and there's 30 days here, but when the stock is sat on the shelf, between when it's sold, well, then you're holding stock, hugely expensive, not just in terms of the cash you spent on it, but you've got to store it, heat it, protect it, shelve it, the whole thing, massive amount of money going into it, hugely inefficient. Can you get that so you bring stock in and sell it more quickly, get that gap down there, but also don't offer large, great payment terms to your customers either. What I found in my experience, the larger the client, the company, the more credit they want. If we're dealing in the B2B sector, the SME sector, for example, business owner to business owner, you can do a deal, you sort things out, payment terms are pretty good. Dealing with a big corporate, for example, they run their whole business on other people's money, i.e. yours and mine, and they want 60 days, 90 days. I've seen 120-day terms sometimes. If you're dealing with the supermarkets, for example, the retailers, they don't want to pay you for the products until they've sold them, let alone anything else. They run their business on your cash flow, your bank account as well, which is challenging sometimes. So to get that cash gap down, improve the cash flow in your business, because if your cash flow improves, you get more cash flowing in, and not that the bank doesn't dip. You can invest that cash into sales, marketing, innovation, creativity, other things to make life better for yourselves as well. Don't leave it sat in the bank or with your clients as well. So that's the cash gap, an interesting one to have a look at. In some businesses it's worse than others. In ours, because we're a service business, we tend not to have inventory. We do have books and inventory, we do other things as well, but not a big part of our business. If you're in the building trade or the machine business or something like that, machine tool business, this is a huge issue, because you've got to buy the machines, big cash, sat on the shelf, sell them, and then you don't get paid for 90 days. This is where we look at debtors and creditors. We'll touch on that a little bit later on. But having this visibility of the cash gap, as we call it, or recognizing the cash gap, can be a very interesting way of looking at it. And again, service business, not quite so much. If you're in the retail or manufacturing or machines or whatever, selling a product and you're buying it in from somewhere else, then absolutely. Now, what can also happen, that you can get even worse than this to a certain extent, is you buy a product, you buy something in, and you add value to it. You machine it, you paint it, you coat it, you pack it, you wrap it, whatever it is. You're adding more value to it. So there's more cash tied up in it. And then when you sell it, the cash gap might be the same, but you've got a higher value product compared to what you bought in. Again, all things you can measure, and you can use a management tool, management technique. If you've got a team of people in your company doing this for you, this can be something, again, you can target them to say, oh, look, we want to reduce the cash gap. We want to get more cash in our account, not our suppliers and our clients' account. What can we do? And they can be quite creative with this when you look at the way they can manage the business for you. So cash gap is another useful, I think, and useful toolkit. And it also then links back into the cash flow forecast that you've generated as well. We touched on this a little bit earlier on as well. The number 20 is the budget. How good's your budget? Do you have a budget? Have you got a sales forecast for the year? Are you predicting? This little spreadsheet here, I'll send it over. You can have a copy of it. There are loads out there. If you're using an accounting package, then there's tools and templates on there. Speak to your accountant. You're welcome to have this one as well. But have a budget, have a forecast. We have a rolling forecast. We have a 12-month budget, and every quarter we roll out another 12 months. We've got a continual minimum 9 months ahead, maximum 12 months ahead. Gives that sort of predictability to what we're doing. We tend to get bookings come in, as you said, that one from 2019. Typically we get bookings 12 months ahead. We've currently got bookings now till end of this year, and we're looking then for next year as well now. So therefore I can start to put my budget together for early stages of 2023 as we go along. So it's a rolling template budget. But what you can do with this budget is you can predict that seasonality in your business. I mean, is anybody here, just type in a quick yes. Does anybody have what called a seasonal business? Quiet at Christmas or busy in the summer? But anybody got a seasonal business at all? I'm interested in that one, just to put it in there. Seasonality is a great excuse used by salespeople sometimes, but seasonal business, just say yes. If you haven't, then it's absolutely fine. A big yes. Okay, so what do you do? What is your business? You don't mind me asking. What are you selling? As it's a big yes there, which is really good. What business are you in? Just type it in so it makes a bit more sense to me, perhaps. Because this is always interesting. Wiring harnesses. Okay, all right. I actually ran a wiring harness business over in the UK long time ago. We were making wiring harnesses for truck cabs, for home appliances. There you go. Great. Yeah. Mistake we made was real quick. Everybody just bear with me here. when we had the wiring harness business, we had a problem. We didn't figure this. I'm sure you do this when we were recruiting people, because we were doing big ones for cabs and trucks and lorries, that sort of thing. It was manually built, maybe yours machine built, but yeah, Christmas sales, absolutely. But we didn't check people's eyesight, and so you get somebody who can't differentiate blue and green. They made a real mess of the wiring harness. So watch out for that. Okay, so you've got a seasonal business because it's appliance based and it's Christmas sales and everybody buys and buys. You've got this high seasonal business. One of the tricks, we can predict that with the budget, of course. The trick is, and I'm sure you've got this covered, but can you flex your overheads to match that degree of seasonality? Can you find another sales, another market to go for when you can plug the gap in the summer, for example, or when you were not getting the business coming through? But plotting or budgeting for seasonality, it's a great way, because what you tend to find is that your sales will do this, busy at Christmas and it crashes and burns by end of March, but your overheads carry on. They all the people just sat there twiddling their thumbs. You're not very careful. I'm not suggesting you're doing that, by the way, but if you look at that, you can put your seasonality in there, and what will happen is your gross profit margin, your gross profit will probably be okay, but your volumes drop. So when you go, you make all your money at Christmas, come the summer, your net profitability drops, and all the money you made, you sort of lost or you spent on your overhead. So having a predictable sales chart, and what this little budget template does here, there's things as sales pattern. Whatever sales you put into it, it will plot out the sales pattern for you and your gross profit net, but then it will show you where your profit's being lost as well. High seasonal business, very, very difficult, very challenging. But again, once you can predict it and you can say, this is what our sales pattern looks like, Christmas is great. What can you do then to either reduce the costs for the rest of the year, or find a sales area that you can go and fill as well? It's difficult. It is tricky. I know, for example, the martial artists will tell me that you can't sell in December in the martial arts or the fitness business, because everybody starts their fitness regime in January. So you have to incentivize people a lot to get on there. But you can find out where these gaps, where these troughs are in your sales month or quarter or year, as you've got there. Then you can start to find a way to plug the gaps a little bit. Not easy, not straightforwards, but once you can measure it, you can manage it, you can have a look at it. And for most companies, there is a degree of seasonality. We find the same sort of thing to a degree. We have seasonality for workshops. Nobody does a workshop in December, for example, because everybody's on Christmas parties. So we have the opposite problem you've got. And then the workshops kick off again when it's a bit warmer in the spring. So there was a seasonality there. Now, the way around that is we would go and do workshops over in the Middle East, for example, in the sort of the Christmas period, go to the Middle East and do workshops over there. Great, different culture. If it's cold over here, we're going to do workshops in Australia. It's summer down there, while it's winter up here, for example. Not easy, but you get the idea. You can find this pattern on your budget, and then you refine as you go along, manage a business around it. What you should also do with your budget, of course, I think when we first started out this sort of conversation, was when you get your P&L, you should be comparing it to your budget, your monthlies, your quarterlies, all the ratios you've got that you predict you're going to get. You put this into your accounting system, or your accountant does, and then you compare, how did you think you're going to do? How do we compare? What's reality compared to what the best guess was going to be? So budgeting is key. I would suggest you use your accounting package to develop your budgets, because then when you do your accounts, your management accounts, it'll compare them and say, getting on with it. And then you can do something about it. But have a budget. Don't leave the budget on the shelf for gathering dust. It should be a live document, a live tool, a live template that you can use with your team. And I enjoy budgeting. I actually enjoy budgeting, because what we can do with them from a budget point of view is that the budget that drives our strategic choices, our activity plans, our 90-day plans, our 90-day sprints that we do, all points towards how do we achieve budget this quarter? How do we beat budget? Budget's just minimum performance. We want to be able to beat through it. So it allows planning, it allows KPIs, it allows review, it allows performance. And we sit down, we're not a very big company, but we sit down and review our quarterly budget, quarterly performance, what worked and what didn't work, and how to improve it next time round. You're doing what I do. I've got to do that because we're leading the clients through it as well. But have a budget. If you want to use this this template, then it's absolutely fine. What you'll also notice on here, just out of interest, is that it gives you a break-even day in the year. When you put all your numbers in here, it'll tell you you've broken even on day 273 of 365, and it gives you, then you can say, well, okay, is that okay or not? Want to bring break even back into the year a bit or whatever it is, but it gives you break even points, it gives you net margins, and it gives you a gap between what you thought you were going to get and what you need to get as well. So I recommend it. Have a play with it. I'll send it over. Sarah will have it. She'll send it out after the workshop. I'll put a bundle together, but get a budget. That's the key thing. Okay. Now we're moving into some balance sheet ratios, which sounds or doesn't sound very exciting, but they are. These are all things that we need to have control over. To number 21 is debtors. And you've heard of the term debtor days. How effective are we gathering our money in from our clients? So when you invoice somebody, you give them a period of time to pay, and there'll be a predicted amount of debtor days. So you have trade debt. Let's say your total debt you're owed is, I don't know, let's say it's 100,000, whatever it is, divided by your annual sales, total sales figure for the year. Overall gives you multiplied by 365, gives you an average running figure of 73. So what it means is that on average it's taking you 73 days to collect a debt from your clients. Now, if your trading terms are 60 days, for example, well, then they're not paying you on time, and you can then target people to go and gather the money more quickly. You can do some deals with your clients. Don't discount, but do some deal, negotiate with them a bit. How can you get that money in quicker? We ask for payment within 15 days in our company, because why wouldn't we? There's no reason not to. And most people, even the big guys, they're pretty good with this. The big companies, they stretch it out to 30 days because they only pay once a month or something like that. There's a ledger run, that type of thing, which is sort of okay. But you find your debtor days creeping up, it means your clients aren't paying you on time. The danger there, you're going to get bad debts coming through. Now, the challenge here is bad debt is a bad thing anyway, of course it is. But what happens is the bad debt doesn't affect your P&L, because that shows sales. And unless you're going to show your credit notes in there or something like that, it's a balance sheet transaction. So watch out for this. You may be strong on the profit and loss. Sales are good. All is great. Not being paid for them, the cash is not going to come in, and you're going to end up bankrupt in the extreme. So manage your debtor days. Have a number in there. What are you predicting your debtor days to be? What should they be according to your terms and conditions of trading? What are they actually running at? And where there's a gap, that's where you focus yourselves. Focus your accounts team, debt collection, whatever it's going to be. Nobody likes shouting at customers because they haven't paid you. But if they're not paying you, then they're not customers really. They're playing nice. We are very fortunate. I'm sure you are as well. We attract very good people to our company. Very rarely do we have a problem with somebody not paying us. It's happened over the years. Occasionally it happens, but because we have a close relationship with our clients and we're doing what we do, they pay us and we're okay. Not the case when we were in the transport business. My goodness, that was horrific. It was full of con artists, I think, over in the UK. So we had big and massive debtor days, and we had to write off some of these debts as well. Not good, and they affect your profitability straight away. So debtor days, you can calculate it, you can measure it, you can KPI it, but get it down. Yeah, transport is fun. Yeah, exactly. Yeah, it can be, but my goodness me, I can tell, not for now, but I can tell you, if we meet up, we should do this. Miss Sarah, we should have a get together in a bar somewhere, and I'll tell you some stories. It'd be good to meet you all. Tell you some stories about transport companies and all the things they got up to. And that's why we don't do it anymore. We sold it and got out of it. But anyway, yeah, transport is fun. Yeah, there you go. Good point. We'll think about that. But debtor days, measure it, manage it, control it, get it down as much as you can. And also then you've got creditor days on the other side of them as well. How quickly are you paying people? And then in principle, you want to pay people slowly and gather money in quickly. We chose not to for our business because it's the way we do things. We don't have big stocks and that sort of thing. We pay people really quick. within a few days if it's been approved. I don't like to owe people money, and there's no reason we should do. We have a great team of suppliers, and we expect and hope our customers will pay us really quickly as well. So our cash gap is small, debtor days are low, debtors are low, and it runs quite lean. But if it's not the case in your business, this is a great way of getting it back under control. So debtors, I mentioned this one as well. Number 22, daily cash in bank. What is in the bank? Because out of all this that we're doing here, look at your business overall. The reason you're really doing it is so you got some cash. That's the acid test of profit and loss and all that sort of thing is cash. Based on your cash flow forecast, you should be able to predict what your daily bank balance looks like, good, bad, or indifferent. Sometimes it'll be great. It tends to fluctuate a lot. When you make payroll, it looks horrible. It dips down again. When your client pays you after the month end, it comes back up again. So it tends to be a jagged curve on cash flow. It doesn't matter. Providing you hit it, you're okay. But daily cash in bank is just a little simple test you can do. You can do it online, of course you can, but do a daily check in the bank, make sure it's still there, and just compare it to your cash flow forecast, what you think you were going to have in the bank and what have you got. And if you've got more cash than you thought, that's still as bad as having less cash than you thought, because it means your prediction was wrong. There's something wrong with the prediction. So I recommend it. We do, or Lynn does it. My wife, she does this. She'll check in the bank, and we do get some shocks and surprises sometimes because, a direct debit will clear or not clear or whatever it is. And but at least we know about it. We want to avoid overdrafts. For me, just another little tip as well, what we do, we have a thing called a synthetic overdraft. We have an amount of money in the bank below which we don't want to go, so it's always positive in the bank. If it goes below that, the bank doesn't care because we're in credit at the bank, it's okay. But for us, that's the level below which we don't want to go, and the alarm bells start to ring. What's happened? But it means we don't use overdraft, we don't use any debt facilities or anything like that. I don't want to, but we have this synthetic amount in the bank that below which we don't want to go. So cash in the bank, as a business owner, senior executive, for example, it's a key driver for you. It's a key driver because it means that you can, what can you do with cash? If you've got lots of cash in a business, is the bank the best place for it? Probably not. It may mean you're not using your cash, using your assets for investments or innovation or whatever it's going to be. So, a lot of cash in the bank is good, but actually it means you're not using the money that you've got to do something more positive for the business. You can invest that cash into something else. I'm not here to guide you on that, not my thing, but cash in the bank might look good, it feels good, but it's not working very hard for you. So really keep it nice and lean. Make sure you can guarantee the numbers, but do something else with it. What I've seen other people do, for example, we have a couple of companies in the UK that we've worked with where they have, cash is good and strong. If they get beyond a certain threshold of cash, or they invest it in some stocks or property or something like this, or a pension fund. They do things with, they make the money work for them harder than sitting in the account. Interest rates are low. Certainly here, I assume that the same for you. The UK has just put their interest rates up to 0.5%, which is still low, very, very low. Money's free. You're not going to make any money by leaving it on account. You've got to make money by putting it into something else, making it work harder for you. That may change. I don't know. It may change. The interest rates will go up. I think inflation will start to grow a little bit. And I think interest rates will have to be used to control it. So anyway, see what happens. I'm not an economist either, but control your cash. Don't go below a certain level, but don't go above a certain level either. If you've got too much cash, nice problem to have, invest it somewhere, use it to the benefit of the business for something else as you go along. Don't go and buy a Ferrari. I'm not suggesting that, but you can, but use it for the investment in the business. But measuring it, daily cash in the bank is a real good discipline to have. So cash in bank daily. Number 23 is stock. Now, stock is an interesting one. It depends on your company. Let's look at an accounting firm, for example. Accountants have a thing called work in progress stock. So what that means is they've done work for a client, and it's not finished just yet. They can't invoice it. It's work in progress, and they value that work in progress. WIP stock, for example. So it doesn't matter whether you've got stock physically sat on a shelf, finished goods stock or something like that. It can be work for a professional services company. We don't do that. Our work is on more of a consignment basis. Accountants do. Lawyers can do it as well. Work in progress, doing contracts and evaluations, that type of thing. If you've got work in progress stock, watch out for that, because it very regularly doesn't always get invoiced, because what you think is work in progress, and if you're in that business, may or may not be invoiced over to the client all the time. So what happens is you will put an adjustment in your P&L. You'll say, look, we've invoiced 50 grand this month, but we've got this work in progress here as well. We've done this amount of work. We're going to add that to the sales figure as an accrual in the account. So it's gone from 50,000, you're going to add 10,000 to it, and you're taking the value of production into your accounts as well. From a management account point of view, rather than financial accounting point of view, it's okay, providing the next month that work in progress figure you put in there actually gets invoiced. In my experience, it doesn't. The work in progress grows and grows and grows and grows. It gets out of control, and when you come down to invoice, you have to write off a lot of it. And what happens then is you have an adjustment in the accounts. 6 months in, you have to write off this work in progress, and you've been kidding yourselves for the first 6 months of the year. So be careful with stock. Be careful with material stocks, work in progress stocks, finished goods stocks, whatever it is. If you've got a stock figure in your business, if I go to a company and they say, where should we look first to get some quick wins? They say, show me the stock room, show me the warehouse, show me your work in progress, whatever it is. And I'd say 9 times out of 10, they've overstated their stocks, and there's going to be a write-off or a write-down somewhere, which is hugely expensive. It might be tax efficient, but it's painful from a profit and loss point of view. So manage your stocks very carefully, because they can get out of control. When I was working alongside the British military donkeys years ago, we had a stock figure, and it was called SDNI, and it was sales delivered, not invoice. So what we had to do, we'd make this thing, a packing case, whatever it was, we send it off to their warehouse. We couldn't invoice for it until they acknowledged receipt of the products, and we got a document back, a proof of delivery came back. When we got the proof of delivery, then we could raise the invoice and they would then pay it. But in between the goods being sent and getting the delivery note back, we had this SDNI stock, and it got way out of control, because people, if in transport is fun, as we know, they lose the proof of delivery, they query it, and this SDNI stock grew and grew and grew. And when I took over, we had to write off a lot of money because the paper trail had gone cold. So if you've got stock in your company, professional services, work in progress stock, this sort of thing, be careful. I would recommend, just for me, operationally, even if you're an accounting firm or something, or for what we do, don't have work in progress. Just forget it, unless it's a huge chunk of money or value that you're losing out on, because the idea is, if you had to avoid work in progress in an accounting firm, stage payments. Have your clients paying on regular standing orders each month, direct debit, so monthly retainers. So a lot of accountants are going over to this now. They're saying, look, rather than invoice you for what we've done, you're going to pay us, $200 a month or something. We'll do all the work, but then you pay us every month. And what that means is that in some months you do little work but get all the income. Other months you get all the income and none of the work. So it fluctuates, but it evens out as you go along. So consider retainers. Going down the retainer route is a great way of doing this, avoiding the need for stock in professional services. We work on a retainer basis with all our clients. We don't do project work, or very rarely do project work. It's all down to regular retainer, regular activities. We don't need stock. If you have stock, have a look at it. It can catch you out. It can be quite difficult. So then we have a couple of other ratios for you to consider, to think about. Number 24, current ratio. It's a balance sheet ratio. How healthy is your business? And this is they call the current ratio. Current assets over current liabilities divided gives you a current ratio. So how that looks is, let's say you've got current assets. I'll explain this in a second. Current assets of 100,000 and current liabilities of 80,000. Your current ratio is 1.25. Now, what this means is, and you may know, but what is a current asset? A current asset is something you've got, you own, that you can release into cash pretty quickly, typically within 12 months. So a current asset could be stock on a shelf. You can sell it and get the money for it. It could be cash in the bank. It could be other things as well, but typically not property, for example. May not be property, doesn't normally a current asset, but current assets, things that you can liquidate really quick if you need to and make it into cash. A current liability is something that you owe to somebody, likely within the next 12 months. It could be trade creditors. You've got an invoice for something, you owe them the money. So it could be taxation, it could be anything like that you owe to the government, for example. So a current liability is what do you owe in the current term, if you like. 12 months is normally the term used. And current assets is what have you got to pay those current liabilities. Obviously, those two should be positive, in your favor, positive. So this one has got 100,000 current assets, let's say cash 100,000 cash in the bank, and liabilities are only 80,000. So debts you've got to pay 80,000. That's great. You can cover all your debts. When the thing to look for is if that starts to get tighter, or your current liabilities overtake your current assets, that's a problem, because you can't cover your debts. That's when you need to get cash into your business quick, because maybe you've got people not paying you, stock you've got to write off, whatever it is. The business is not efficient and effective and running, and it's going to affect your current ratio. Banks look at current ratios a lot when loaning money. How effective are you at working with your cash? How effective are you at bringing money into the business? What is your current ratio? Now, what's the best ratio for your business? Is it 1.25 or 1.5? Or who knows? It doesn't matter particularly, providing it's positive. You can do a benchmark on different sectors, different industries, and find out where it needs to be. But you can predict this by looking at your cash flow and your budgeting and forecasting. You can say, oh, look, this is where our current ratio is going to be. And again, it's another good accounting term, but also a good KPI to have. Don't allow our current ratio to dip, because if you're in a growing business, if your business is growing quick and it's sucking cash, then maybe your current assets will drop and your current liabilities will increase. If it goes negative or down to below 1, 0.8 or something like that, you can claw it back if you can predict it. If it keeps on collapsing down, though, it means you're not going to pay your suppliers, or you won't have the ability to pay your suppliers or pay the things that are owed out there. That's when businesses go bankrupt, when they can't pay their short-term creditors. That's when businesses go bankrupt. So this is a key one. Stay stay positive on your current ratio. For us in our business, because of the type of business we are, we don't have a huge amount of people we're paying, so it's easy for us. We don't have a lot of debtors, a lot of creditors, so it works well. You may be different business model where this is easy to creep up. Where it creeps up really easy if you're buying stock or buying products, or I've got a lot of suppliers out there, they want their money, and if you can't pay them, they'll stop supplying you, stop providing you with services, and then you're done. That's it. That's how you lose your business, which I'm not recommending or suggesting you do, but watch this ratio. If this starts to creep down, it's a negative indicator. Just watch out for it. The way around it, of course, if you need more cash, is to go to the bank. I need an overdraft. I need cash. I need a loan, whatever it is. That's why when you go all the way back to cash flow forecasting, if you can predict, for whatever reason, cash being tight or the current ratio dipping, once you put cash onto your balance sheet, it's a current asset. It reinflates it again. You're okay. We don't want to live on debt. We don't want to live on these sort of things, because the beauty of it is, if it's a long-term debt over 5 years, it's a current asset, but it's a long-term liability, not a short-term liability. So they don't balance off. It improves your balance sheet. So you can get a loan, but if you control and you understand the numbers, the bank's much more likely to give you the money, loan you the money, if you've got control over these things, cash flow forecast, budgeting, you understand the ratios, current ratio, there's loads of these ratios that accountants love to play with. Operationally, this is just an interesting one you can have a play with. So any questions around current ratio? I know we've covered quite a bit of ground there. I don't want to be too technical. If in doubt, you don't need to do this. get your accountant. Yeah, how's our current ratio this month? Let's tend to get on with it. It'll be fine. And then you can look at it, and then you can say, well, how can we improve it for next month? But any questions around current ratio and assets and balance sheet ratios? If not, it doesn't matter. I hope this is all making sense. Again, you get the video coming through in the notes as well. But 24 current ratio. So we've got a couple more slides to go. We're going to sort of wrap it up at about sort of what's going to be 1:45, 10 to. That's the time for Q&A. So what I'm going to do, I'll sort of pause when I finish the slides and open it up to everybody. Any questions you've got, you're welcome to ask. You've got me captive, and have a think. What questions would you like me to answer? If I don't know, I'll find out for you. So another couple of slides to go. We're into Q&A after that. I'm here to help. So I think, I'm not sure who was it actually, just I forget now. I had a conversation on LinkedIn this afternoon with somebody, and they said they were going to come on this. I said, don't ask any tricky questions. Who was that? I forget the name. I apologize. I've forgotten the name. LinkedIn's obviously shut on my screen here, but there was somebody I said, don't ask any tricky questions, but now's your chance. In a couple of minutes, now's your chance to ask any tricky questions you've got. Okay, so number 25 is working capital. So this is current assets minus your current liabilities. What have you got in the business? What can you get your hands on working capital wise to buy stuff? Basically, this is what it looks like. Yeah, thanks. I don't like tricky questions. It's too late in the afternoon for tricky questions. So if you've got current assets of 100,000, current liabilities 80, working capital 20,000. It's very similar to the current ratio. The same calculation applies. You can get your hands on 20,000. Now, if you get for example, how this can show up, if you get a good offer on a computer system or a good bit of machinery or whatever it is, and you go, wow, here's something we need. We could buy this for the business. If you've got working capital, you can get that money out and spend it on plant and equipment, for example. You invest it in something, but we always need a bit of working capital in the business, because you're going to get shocks and surprises come through. A tax bill might arrive, or whatever it's going to be. Your insurance bill might pop up, or whatever it's going to be, or you drop your mobile phone and got to buy a new one. Whatever it is, a bit of the liquidity on the balance sheet is key here. So you want a bit of flexibility there. Working capital, don't run too lean. It's good to be lean in a business. We know that we want to be lean and effective and efficient, but have a little bit of slack. I say we have this amount in the bank account is our working capital, below which we don't want to go, which enables us to, maybe we've got to book a future book and pay for a hotel or a flight somewhere, or upgrade a computer system we didn't anticipate. We've got a bit of cash in the bank, means we can go and do these things and keep it all flowing along. So working capital is key. It's the lifeblood of the business, and this is not affected, remember, by your profit and loss. Profit and loss is transactions, not cash. This we're looking at here, this is balance sheet, cash flow. These are your cash ratios. And the danger is, if you only focus on your profit and loss account, your P&L, that you won't see it. Doesn't measure cash, and you'll get some surprises coming through in your bank account. So do both. I recommend I do both for it. And then finally is number 26 is equity. This is what you're looking for. Remember, we're all the way back in the first couple of slides looking at a balance sheet. So total assets. This is total assets now, not just current. What do you own? Could be property, could be stock, could be all sorts of things. Intellectual property, goodwill, all gets lumped into it. Total assets minus total liabilities. What do you owe? Total. If you shut the thing down, what do you got to pay to get out of it? Total liabilities, not just current. So 250,000, let's say. Total liabilities 150. Owner's equity is 1,000. And from business owner perspective, that's really what we're looking at. We want this equity in the business. If I'm valuing a business, to want to buy a business, want to sell a business, I need to know they can generate owner's equity. I need to know they can generate sales and profit and cash, but also that it's using the assets that it's got in an efficient way, such that I don't need to go there anymore. I can just invest in it, buy the business, it'll run, and gives me that owner equity to come out of it. We're building owner, shareholder funds, all this sort of thing. If you're working in a company company that is privately owned, you're likely going to get pressure from the shareholders to drive this figure. Yes, they want profitability. Of course, they want profitability. That's the oxygen for the business. But owner equity is where they derive their value, and where dividend may come from as well. So you're going to get pressurized on this. So it's not good enough just to be focused on the P&L, the sales and margins. You've got to be aware of the balance sheet implications as well. So owner equity is a key driver. We do the same. We have on our balance sheet, want to know, we own the business. Lynn and I, we're 50-50 in the business. Well, I think we are. I think I own the same as Lynn, I'm not sure. And we have our target for ourselves, what we want to have the business to look like. And same with clients. Regularly, if we're working with business owners in their companies, a key KPI for them is equity. What's the business worth, a valuation of the business, and away they go from there. If a lot of people want to maybe sell at some point in time, it's a great way of deriving value. So those are the 26 key indicators or ratios and numbers. And again, I'm not an accountant, as I said, but these are things I found helpful for me in business, running a company. I want to know about these things with my clients when we look at how they manage and run their business. These are good indicators. There are lots more out there that may be appropriate and applicable to your business. This is not the only 26, clearly. There's hundreds of them, I suppose, if you look at it. These are the most common ones that I've come across. Other ones would include, some sort of customer service numbers in there as well, could go into it. All sorts of things can go in there, but these are probably the key 26 would apply to most businesses. So that is really the content sort of completed for the workshop. I hope it made sense. I hope you enjoyed it, and I didn't send you to sleep. It's quite a dry subject, this. It can be quite a dry subject doing finance. I hope I've added a bit of life to it for you and that it's made sense. So that's all the content done. So I am now yours. Has anybody got any questions or thoughts or observations I can help with? I'll put it onto the final slide, which is going to be that one, which is the final slide in the deck, and we're bang on time with 15 minutes to share. Anybody got any questions? I'll give you a minute or two to have a think. You're welcome to type it in. I can bring you onto the call. We can talk about it as well. This time is yours. How else can I add value to your time and your afternoons? Please type it in. As I said before, not too tricky. Don't try and catch me out. But any questions, please type them in. Now's your chance. Well, I have a quick drink of water. There we go. Okay, nothing so far. That's a good thing that it was clear for everybody, or everybody's completely confused and don't know what to do. I hope it's the former, clearly. Okay, I'll ask you guys a question then, just to make sure you're awake, if that's okay, because it's good sort of validation. Just if you could just type in what's one thing you're going to take away. What's one thing you're going to take away and do or change or measure and adapt? What's one thing you're going to take away? Hopefully more than one, but just one thing you're going to take away and do differently as a consequence of maybe this workshop. What's one thing you're going to take away and do? Just maybe type that in as well. And I'm always intrigued. Order intake. Okay, great. Yeah, it's a nice. We know it intuitively, but plotting it out. When do we get the order? What's it look like? It's a good leading indicator, and it's quite nice to look at it. Really, what it means is if it's not hitting the graph as we predict it to, it dips down, we can do something about it because we're ahead of the curve. And of course, if it starts to rise up, we get more orders than we anticipate. Then we can start to look to maybe recruit or get resources ready to go, and we iron out the bumps in the system. So order intake, fabulous. Thank you, love it. I'll send the template across. You're welcome to use it, and hope that helps. Anybody else? Anything else anybody's going to take away and use as a consequence? Hopefully something. The order intake is a very good one. So great, thanks for that. Never drunk so much water. My goodness, it's quite dry doing this, talking for so long. Yeah, good. Yeah. Thank you. Yeah, I love you. Thank you for playing nice. Okay, great. Thank you, Ivan. Yeah, debtors. Yeah, it's something that creeps up on us as well. And we're always very sort of cautious about chasing clients for money. There's a way of doing it, and a nice way of doing it. Sometimes they've just forgotten, haven't received the invoice, whatever it is, but keep on top of it, nice and gentle. And the phrase we would use for people, Lynn does this with clients occasionally, certainly the big guys, just checking received our invoice, it was due for payment on Friday, is everything okay? That nice and gentle. And they come back and, oh, we didn't receive the invoice, can you resend it? Okay, great, off we go. But keep on top of it, keep ahead of the curve. We don't want to have to chase money, particularly with any of our clients, but do get the money in. If it's a legitimate sale, legitimate invoice, don't let them get away with it. They should pay on time for you, and be prepared to take them to court if you have to. So great. Added value, yeah, exactly. Great idea. That added value. Nobody cares about the cost of what you do, the hourly rate you pay your people, your team, whatever it is. We shouldn't really price on that. We should price on value, added value. It's a tricky one, but then there's a lot more profit in there. It's perceived value. What I mean by that is the value the client perceives is what is the price they'll pay. If they perceive low value, they're not going to pay very much. And it's up to us as owners and entrepreneurs to build a value proposition such that they go, no, this is great. One thing for me, for example, one of the things I say is I want to be free to my clients within 3 months. What that means is we've got to build the profitability in the sales and all this sort of thing, such that my fees are more than covered within 3 months. Then we're happy, away we go. Everything else they keep, and that's just that added value service. And what I've found is they don't mind paying, providing they get more back. If they give if you put €1,000 into a bank and you get 5,000 out tomorrow, well, you do it every day, you don't care. It's an added value perception, which is a great way of doing it. So yeah, love it. That's really good. So it's a work in progress ideas there. Great, thank you. Anybody else, any sort of tips, ideas they're going to take away? There's some 3 really good ones there, so that's great. Again, and stay out of the transport business. I share your pain. I didn't enjoy transport business. I like driving, but I didn't enjoy the transport business. It was horrible. Anyway, there we go. I don't know if it's horrible everywhere, but I sense it may be. But yeah, stay out of transport business. Not great. Excellent. Yeah, conversion rate. Again, measure it. I think we always tend to over egg conversion. Yeah, I think we're doing 80%. When you measure it, it won't be 80%. It'll be lower than that. But again, that's a good thing when you're realistic about it. The business is fine, even if the conversion rate's only 1 in 3. It's fine. But then you can look at your prospect journey. The marketing. Are you looking after people? Are you guiding them through to the sale, to the purchase? How's your sales training? Are you negotiating well? Are you closing the deal? All these sort of things. It's quite complicated, but you can map out this, what I call client journey, from prospect to client. What journey do people go on? Where do they fall off? Where do they fall out? And you find out where they fall out and fix it. That will improve your conversion rate. So you can map it out and spend a little bit of time on it. So yeah, great. That would be really good. Yes. Okay, great. Yeah. Direct costs, because they leak out, don't they? The costs, they just leak out the company. And is it direct cost? Is it overheads? Are we kidding ourselves in terms of our gross margin and net margins? Be really clear on it. And yeah, and per client type too. Yeah, love it. If you can fragment your sales ledger, you're bound to find you've got some clients you're making no money on, just making no money out of it, and other ones you are. But sometimes I've always found this out of interest, and maybe your experience, but the clients who don't make any money out of are the ones that take all the time. They're the ones that are hard, they're tough, they negotiate hard, they moan about things. You make no money out of it. The other ones that play nice, you don't deal with them, then they're okay. So yeah, fragment it down by client type, distribution type or product type, whatever it is, and manage the numbers. So yeah, great. Direct costs and direct sales costs, great way of getting the business up. So okay, brilliant. This is really good. Great. Appreciate your feedback. Okay. Thank you. Oh yeah. Okay. Thank you. So I'm just reading. I'm trying to. I can't read this quick. That's really kind. Thank you. I mean, I hope this is just based on my experience of doing what I do in my career, in entrepreneur business, that sort of thing, and with clients now. Easily missed. When I was running my other companies, I didn't do all this. I no way I did all this, but I found that this was a good disciplined approach to it. And you haven't got to use all of these. There might be other ones you need to use, not these, for example. But if you can use, I know, pick a top 10. I'll give a 10. That'll be a great start. And that will give you some control, predictability, and hopefully improve your profitability as well. So that's really kind. So thank you for that. I really appreciate it. Okay, anything else I can help you with? I'll get the recording, the slides, the templates all bundled up, and maybe tomorrow now when I get it all downloaded and sent across to Becerra. Becerra, anything else from you? This is your workshop. I really appreciate you giving me the opportunity of speaking with your clients. This is a Dascali workshop. Becerra, anything to add or wrap it up with as we begin to finish it up now? You don't, okay, in fact, you're very, very kind. That's great. Good. I'll take that as being good news as well. So, well, look, thank you. I appreciate everybody's participation. I hope it's been great value. And I look forward to seeing you on other events as we go along. Speak with Becerra. She's got a full calendar of events coming through, and I'm sure there's things that she wants to invite you to as well. I hope I see you again on future events as well. Maybe when we're allowed to, I'm with Becerra talking about this, maybe Becerra will invite me over to Macedonia, do a live event over there as well. We can meet in the bar and share stories about transport or something.
Yes, I would just want to ask everybody. I would really appreciate if we have, if I can have a testimonial from every one of you. How did you like the event? Do you have anything you didn't like? Anything to add? Please feel free to send me an email. I would really appreciate it.
Fabulous. Absolutely. Yep. Great tips. Thank you, Becerra. Okay, so I think we can wrap it up there. I think I'll let you go. Thank you for the afternoon. And all I'll do now, first thing I'm going to do just real quick before I wrap it up, I'm going to just pause recording